And here are your headlines. Inflation angst, global bonds slump as fears build over the impact of rising interest rates. Jamie Dimon and Nobel Prize winner Ben Bernanke join the chorus of caution. Gilts on edge. Parliament resumes today for the first time since Kwasi Kwarteng's mini-budget wreaked havoc on markets. The BOE steps up its bond market intervention this morning. Plus, Joe Biden pledges more military support for Ukraine as Vladimir Putin threatens additional attacks.
Now, this is the picture for the futures. Of course, a lot of focus is not only what happens at the Fed, but the Bank of England. We look at gilts very specifically because it seems that no matter what the BOE does, they just can't get out front. DAX futures and FTSE futures down some 0.6%.
Yeah, absolutely. To your point, that remarkable sell-off once again in gilts yesterday. Towards the end of the session, you saw gilts up between 20 and 30 basis points across the yield. And the BOE, as we said in the headlines, intervening once again, so broadening their scope of intervention to start adding gilts that are index linked as well. And in terms of the language from the BO, warning about what they describe as fire sale conditions, warning about the impacts on the financial markets then. Fire sale conditions are what they want to avoid, and they're broadening that scope. We'll check in on gilts in just the next few seconds. The futures are pointing lower. You had 4 straight losses stateside. Futures in the US also pointing to further red across the equity space. The Spanish IBEX currently down 55 points, a loss of 0.7%. The CAC 40 in France are down 0.8% now as well. Here in the UK, the FTSE 100 off by 0.5. The jobs data, again, at the same time as the BOE is intervening in the gilts market, it also has to position around a tighter labour market, 3.5% in terms of unemployment. That is the lowest level of unemployment for about 50 years, increasing the expectations, particularly amongst our team at Bloomberg Economics, of a more aggressive BOE on November the 3rd. Let's switch it over and see how things are playing out then across the assets. Future stateside, as I said, pointing further losses down now at 1%. And by the way, the sell-off isn't just in gilts, it's also in treasuries across the curve, yields up. The pound at 110, that's a drop of 0.4%. Again, as the Chancellor is going to face additional scrutiny over his mini-budget. He's brought forward his plans to reduce or release those fiscal plans towards the end of October. The 10-year over in the US, 396, that's a move higher by almost 9 basis points. And Brent, $95 a barrel, down 0.9% on growth concerns. We're switching it over quickly to look on gilts. Of course, they just opened in the last few seconds. The fresh headlines, of course, being what is happening with that BOE intervention. You can see yields are off just a little bit, down 4 basis points on the 5-year, 4.58, the 10-year 4.44, so currently down 3 basis points on the yield. So a little bit of movement there as the BOE steps in with that additional support. We'll continue to watch this space, of course, because of the pressure from the gilt markets and how it translates particularly into the housing markets. Francine.
Tom, if we dig a little deeper into some of these sectors, actually none of them are in the green. So we have a couple of very specific companies that are still managing to hold up, but overall the 19 groups are down. I'm looking at basic resources, energy, insurance on the way down the most, between 1.7 and 1.3%, and then also look for chip makers that are having an impact on technology here, because we're seeing a rout that also continued in Asia, Tom.
Now, as the Fed's fight against inflation continues, the heads of the IMF and the World Bank are warning of a rising risk of a global recession.
There's the risk and the real danger of a world recession next year. The advanced economies are slowing in Europe. The debt levels for the developing countries are getting more and more burdensome. The rise in interest rates puts added weight on it. And inflation is still a major problem for everyone, but especially for the poor.
The risk of recession has gone up. The total amount that would be wiped out by the slowdown of the world economy is going to be between now and 2026, $4 trillion. This is the size of Germany GDP gone.
Okay, joining us now for more is Christine Aquino and Emmanuel Koch, heads of European Equity Strategy at Barclays. Christine, let's start with you then on the recession risks. The concerns have been heard there, voiced by the World Bank and the IMF, at a time when Goldman Sachs are saying we should not be pricing in a Fed pivot. They remain short equities, at least in the short term.
Yeah, Tom, I mean, I think this is the part now of this policy cycle where we're seeing opinions diverge over where the Fed and central banks in general can go next, because after a few rate increases over the summer, we are starting to see some of those filter through to the economy, and what we're seeing is really not great. Again, risks of recession very much at the forefront of investors' minds. That's starting to get borne out in the economic data as well, and so you would expect at this juncture to see that division between the camps that think, no, the Fed has to keep going and really tackle this inflation issue, versus some of the more cautious camps that say, actually, we are now starting to see signs of the economy buckling under, in some ways, quite an unprecedented cycle of policy tightening across the globe. It's very interesting, again, Tom, that you pointed out the camps that are in each group. One of them is, of course, Goldman saying that it's too early for a Fed pivot. And then on the other hand, we have Lael Brainard from the Fed itself. We do know that she is quite a known dove, but she is acknowledging the impact now of the Fed's tightening cycle in the world economy and how that's going to feed back through to the U.S. in a negative way.
Emmanuel, how much more brutal will the markets be? And I know you've changed your positioning into value defensive stocks. Is that still the strategy?
It is, and I think what we've been seeing so far is a very orderly de-risking. There was no panic in the market. The panic was very much in rates, in FX, but now it's spreading to the equity market. And we are seeing in the last couple of weeks more sign of de-risking, selling by real money investors who have been waiting to see evidence of fundamentals deterioration. So I think the complexity of this market is that there is no put from central banks. We've been used to invest in a world where central banks were always coming to the rescue for the last 10, 15 years. And now this era is finished, is gone, and we need to learn to invest without this put from central banks. So something has to give. Either central banks come to the rescue, otherwise I think the market has to get more nervous about a fairly disorderly sell-off from here.
Okay, there may not be a put, but there's a backstop, at least the BOE, that's how they're describing it. Again, describing what they see as significant repricing of UK debt. The dysfunction in this market and the prospect of a self-reinforcing fire sale is what they want to avoid. Christine, remarkable language from the Bank of England.
Absolutely, Tom. And that in and of itself is actually quite worrying, the fact that they are referring to what they're seeing in markets as a fire sale. I mean, that's partly probably why we're not necessarily seeing the intended effect of the BOE's measures in the markets. I mean, they do continue to sell off. And I think this most recent action was prompted by yesterday's sell-off in index-linked gilts specifically. This particular sector, of course, is still quite a large proportion of the holdings by a lot of pension funds, and the fact that we are seeing that selling off as well, clearly worrying the BOE, hence they decided to step in with more measures. It's going to be interesting to see, Tom, how far the BOE is willing to go in terms of its support for bond markets, and whether this does factor into their longer-term policy trajectory, particularly when it comes to the process of quantitative tightening or rolling those previous bond purchases off their balance sheet.
Emmanuel, overall, so we'll talk about the Bank of England in just a couple of minutes, but overall, do you think there's a willingness for central banks to do more, or does this just have to unwind itself?
Well, I mean, there is no easy option for central banks. I mean, they keep telling us every single day inflation is the main concern they have, and they have no other solution than slowing the economy in order to get inflation under control. But obviously, the balance of risk now is shifting towards financial stability. And as we know, central banks have dual mandate to preserve financial stability and price stability. So what the Bank of England has done is telling us that there is a bit more nervousness from central bankers on financial stability. But at the end of the day, we got the data this morning, still a very, very tight labor market, still very high inflation. So there is no free lunch. I mean, in our view, there is not much central banks can do to support the market. They can provide a backstop, as you said, Tom, but they cannot really stimulate the economy. So the market is entering an era of slower economic growth without this ability from central banks to help on the growth front.
Yeah, and the million-dollar question is actually here in the UK, the backstop doesn't seem to work. So what happens next? Bloomberg's Christina Kino, Emmanuel Co stays with us. We'll talk a lot more about the UK, Tom.
Yeah, coming up, the British Chancellor is set to face Parliament against that backdrop then of the market volatility we're just discussing and, of course, intervention in the UK bond markets. We'll have the details. That is next. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Welcome back to the Open. We are 11, almost 12 minutes into the European trading day this Tuesday. You're looking at losses of 0.9% across the benchmark. Futures in the US pointing lower by close to 1% following 4 straight days of losses. Here in the UK, the FTSE 100 trading at 6,892. That's a drop of 66 points.
Now, the UK Chancellor is set to face members of Parliament later for the first time since a market rout caused by his fiscal policies.
And this comes against the backdrop then of more volatility in the debt markets. UK gilts sold off again yesterday. Their bid slightly today, led by inflation-linked notes. That was yesterday. Again, bid today on the back of this intervention. The Bank of England has now announced new plans to widen the scope of its daily intervention. Emmanuel Co is head of European equity strategy at Barclays and remains with us in the studio. We were just talking in the break about the conundrum then for the BOE at a time when the labour market is very tight, 3.5% unemployment, markets expecting at least 1% come November the 3rd, and yet it has to intervene in these markets, managing these tensions, and then, of course, the politics overlay.
I mean, this is one of the complexity of this market, where for the past 10, 15 years, we have used to be bailed out by central banks. So whenever something was going wrong in market, in the economy, central banks were coming to the rescue on demand. And now, well, we are facing this issue where central banks have to focus on inflation, they have to slow the economy, but they also have to preserve financial stability, and the balance of risk are now shifting more to financial stability. So I think in terms of central bank's credibility, there's a question about how much they can do to stabilize market without losing credibility on the inflation fighting front. And it feels to me that what the Fed told us last week is very clear. The Fed doesn't want the market to extrapolate what the BOE is doing to the US. The Fed is telling us, look, the BOE is doing what they have to do to stabilize the market, but our number one mandate is very much to focus on inflation, and we keep pushing on the brake.
The BOE is trying to stabilize the markets. I mean, at the moment, this is the second kind of scope or intervention. It hasn't really quite worked. So what do they need to do now? How aggressive do they need to be with interest rates? But also, how long do they need to keep the backstop for the market to stabilize?
I mean, the market knows that the backstop would end on 14th of October. So by the end of the week, the BOE told us they would stop buying bonds, right? So this is a market is very much focused on the fiscal side of the equation. What can the government do to regain fiscal credibility? So we are waiting for this new budget announcement for these spending cuts. So I think, there is no free lunch here. If you have a very expansionary budget, which is not funded, you would expect some wobbles in the bond market. And I don't think the BOE can be on its own, stabilizing the bond market completely without some credible fiscal announcement on the other side.
So you don't think we're topping out on yields at this point?
I think the bond market is going to be still very, very volatile. Well, firstly, until you get some kind of inflation peaking, but also until you get more credible fiscal policy announcements.
Where are you expecting interest rates in the UK to be by the end of the year? And we're hearing, for example, from the Santander UK boss saying that more customers are falling behind on payments.
Yeah.
So what does that mean for attractiveness of UK assets?
Well, I mean, you have a market which is pricing, roughly speaking, 150, 175 bips hike by the BOE into the end of the year. There is no way, obviously, the BOE can meet that. If they do what the market is pricing in, we think that will create significant risk to the mortgage market, to the UK economy. So to some extent, there is a limit to what the BOE can do to meet market expectation. And again, they need to balance the risk on financial stability and the risk on growth and inflation. So
what does that limit look like?
I mean, we think that they will probably do 75 basis point hike next month, but not how much, not what the market is pricing in. Again, it's very much about the government announcing credible announcement, and the fact that in the last 10 days we already had some of the measures announced earlier, being removed, right? So the government is starting to be a bit more aware of the risk of financial stability.
What's your take on Europe right now? So we're hearing also noises from Germany and saying, like, look, they're ready to help out for some of the joint issuance and things like that. Is that really a temporary measure, or is it Europe on a new path forward?
Europe is always making big steps when we have crisis. So this kind of old project of fiscal integration started 2 years ago with COVID and the EU Recovery Fund. So clearly, any sense of more integration to tackle this energy crisis would be probably welcome. But I think what the market wants to see is something that goes beyond the emergency package, something that goes beyond the kind of firefighting. You want to see something which aims to grow the economy over time and to invest in a way that some of the issues that we are suffering from at the moment, energy security, defense, will be resolved in a productive way. So what we want is investment in Europe to deal with kind of stagflationary shock. So fiscal spending is good if it is credible to some extent, and if it is coming with productive gain over the long run.
On earnings, and we're shifting into that this week, particularly towards the end of the week with the banks out of the US, the consensus is for high single-digit EPS growth into 2023, margin expansion. Does that hold?
I don't think it does, and I think the Q3 numbers will mark an acceleration in the downgrade cycle. So far, we've seen a bit of disconnect between what has been a fairly tricky, weaker macro environment and still a very confident corporate sectors. Earnings have been holding up fairly well this year. So my market, the equity market, has been completely driven by rates. So we've seen a massive valuation adjustment in the backdrop of rising rates. Now the focus is shifting on what this tightening policy means for the real economy and for earnings. And we've seen a number of high-profile warnings in the last couple of weeks, so we know what to expect for Q3. I think the outlook will be fairly cautious. I would be surprised if you get a lot of companies telling us everything is great. So I think we're going to see a bit of, repricing of expectation into next year. And there is no way you're going to have pretty much double-digit EPS growth, margin expansion in a recessionary environment.
So what's the sector that you'd be selling off right now?
Well, we are very cautious on some of the cyclicals, which are still on high multiples, like industrials. We're underweight industrials. We think the inventory cycle is turning, basically, and that's going to hurt margins, pricing, and volumes. We are underweight on the weak balance sheet sectors, like real estate. What we like is a mix of value and defensive, as you said, Francine. So we like energy. We still believe we have an energy shock to deal with. Energy sector, utilities we like. We like healthcare as something which is defensive and dollar earner. You have some of the cheap opportunities now emerging in cyclicals, like autos or bank look very, very cheap. But again, we don't think this is going to prevail when you have so much risk or uncertainty on the earnings front.
So it sounds like you're looking at autos and banks potentially. You're potentially lining up an entry point, but you need to see a catalyst.
Well, we are starting to see some opportunities. So maybe working on the shopping links makes sense. At time of stress, you want to start, looking at opportunities and how you make money over the long run. I'm just saying that there is no catalyst so far to arbitrage those cheaper valuations. And to some extent, we have not yet seen the balance sheet or the earnings risk being repriced. So we are working on some of the shopping lists, but we are not in a rush to step in.
I was going to say, it's like catching a falling knife.
Indeed. Yeah.
So how do you catch it?
well, firstly, we are not trying to jump in. We are not catching it yet. We are thinking about how to catch it. But, again, I think patience matter in those markets. And again, we had a flash crash 2 years ago. Yeah. We don't think this one is going to be the same. We don't see a V-shaped recovery. We don't see urgency to step in because, again, for the time being, central banks need to slow the economy. Once they want to help us again, once they want to turn stimulative, then you want to kind of step in and buy the market because at this stage, fundamentals don't really matter. You just buy the put from central banks. We're not quite there yet.
Emmanuel, thank you so much for joining us. Emmanuel Coder, head of European equity strategy at Barclays. Now, coming up, Russia's strikes on Ukraine are widely condemned as President Putin threatens to launch more missiles. We have the details next, and this is Bloomberg.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
Has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. 23 minutes into your European trading day. You're seeing losses of 0.7% across the benchmark. Futures in the US also pointing to build on the losses. 4 straight days now of losses in the US. It looks like you get a 5th straight day as well as markets readjust again to the concerns around higher rates and what the inflation dynamics mean as we lead up to that Thursday print out of the US. The movement again in the gilts market, though, as the BOE intervenes and it expands its intervention, Francine, and you now have yields coming off quite significantly across the curve in the UK. So a 10 basis point move lower at the front end, for example, 428 on your 2-year.
I mean, one of the smartest people that I speak to on gilts is Van Ramen. He's saying, look, at the very least, the trend stabilize. They have to persist with, of course, some of the backstop for another 2 weeks. We get into the November 3rd then meeting for the Bank of England. And then what happens on November 3rd? Do they hike by 1 full basis points? What does it mean for mortgages? Certainly, investors will keep a lot of pressure on some of these gilts.
Yeah, that need for stability, as you say, and really fascinated to think about how they're going to weigh up the OBR analysis and forecasts alongside that fiscal plan from Kwasi Kwarteng, again, as you said, who's bringing it forward. Currently, again, yields off across the curve, down 10 basis points on the 2-year. They've expanded this intervention to include gilts that are index linked, but at the same time, and the flip side of this, and we're discussing with Emmanuel Cole, the labour market here remains very tight, 3.5% unemployment, which means they are going to have to raise rates, but maybe not as aggressively. Emmanuel Cole from Barclays is saying 75 basis points on November 3rd, not 100, which is what the markets are pricing in.
Except if you have a very tight labour market, then it means that inflation is actually going to increase as people look for some of the jobs. So I have to say, no one would want the governor's job right now.
Tough job.
For the longest time, as anyone can recall. Also, the UK has run a deficit in its current account. Certainly, now they're paying the price for it. Now let's get straight to the Bloomberg Business Flash with Alice Atkins. Hi, Alice.
Hi, Francine. Bloomberg has learned the UK is pushing ahead with plans to set a cap on the revenues of renewable power producers. Government officials held talks yesterday with energy companies on a mechanism similar to the one proposed in the EU. The move would limit revenues and channel the funds to help struggling consumers. Rivian shares have tumbled after the EV maker said it would recall nearly all the cars it's delivered after discovering a minor structural defect. The US company says while the issue was only found in 7 vehicles, it's recalling about 13,000. Rivian only recently overcame production problems and part shortages. And London's most expensive home is up for sale again. Bloomberg has learned the chairman of embattled Chinese real estate giant Evergrande has put the Knightsbridge mansion back on the market. The 45-bedroom property overlooking Hyde Park was snapped up for £210 million in April 2020. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed.
Now, Tom, coming up, the German Chancellor Olaf Scholz will reverse a long-held position and support the issuance of joint European Union debt to ease the energy crisis. So we did talk to Emmanuel Cole about that a short while ago. We'll, of course, explain the significance of this move and whether it can hold beyond the crisis. A lot going on in the markets, and we're seeing a sell-off across the board.
Yeah, quite the U-turn from the Germans then in terms of that joint issuance on debt. Maybe taking something of a playbook out of the pandemic response as well. But clearly, the Southern Europeans will welcome this, but there are those important conditions. We'll get all the details after the break. Currently, your markets here in Europe are lower by 0.5%. Futures in the US are pointing in a similar direction. Euro dollar at 97 cents. The pound is at 110, down 0.2%. Stay with us. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Inflation angst, fears build over the impact of rising interest rates. Jamie Dimon and Nobel Prize winner Ben Bernanke join the chorus of caution. The BOE steps up its bond market intervention this morning. Parliament resumes today for the first time since Kwasi Kwarteng's mini-budget wreaked havoc on markets. Plus, Joe Biden pledges more military support for Ukraine as Vladimir Putin threatens more attacks on Ukraine. So, Tom, if you look at the markets, I have to say, there's nowhere to hide. Nothing's looking pretty today.
Yeah, it's pretty grim once again. The geopolitics were front and center yesterday. The BOE has intervened today, and we'll check in on the gilt markets shortly because there's been a little bit of relief. But how long that lasts, as you say, as the Chancellor heads to Parliament, he'll be grilled again on his fiscal plans that he's brought forward to the end of October alongside the OBR as well. Really interesting to hear, though, from Fed officials, the senior Fed official, Lael Brainard, overnight in the US, of course, the vice chair of the Federal Reserve, saying we have to monitor global risks as well, and talking about the lag in terms of the rates that have been pushed through and the time frame for when that starts to impact the economy. So possibly hinting at a slightly more cautious approach, even as others suggest, like Goldman Sachs, that it's no time yet to price in a pivot from the Fed. The European Stock 600 currently down 0.5%, so continuing the selling pressure here. The FTSE 100 off by 0.5% as well, despite the fact that the labour market came in with a pretty solid number. In fact, the lowest unemployment rate, 3.5% for 50 years. But of course, that does make the job of the BOE that much more difficult and just raises the bet on a more aggressive Bank of England come November the 3rd. The DAX over in Germany off by 43 points. Switch it over, see how things are playing out across the sectors. There was a handful the last time I looked that were in the green, including retail, real estate, and those are the two really at the top of the list. Retail up 0.3%. Everything else in the red. Heavy selling across basic resources, chemicals, and energy. So that is the sector look. And as well, we'll check in, if we don't know now, we'll look at gilts as well, because you do have some money flowing into gilts again on the back of that intervention from the BOE. Some pretty interesting language in terms of their statement, saying that they are pushing back against what they see as fire sale dynamics within these bond markets. Let's get to the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. The heads of the IMF and World Bank are warning of a rising risk of a global recession. IMF Managing Director Kristalina Georgieva says higher interest rates are adding to debt pressures on developing nations. She says about a third of the world economy will enter recession this year or next.
The risk of recession has gone up. The total amount that would be wiped out by the slowdown of the world economy is going to be, between now and 2026, $4 trillion. This is the size of Germany GDP gone.
French drivers face more fuel shortages after unions vowed to continue strikes at the country's biggest refineries. President Emmanuel Macron's government is being urged to mediate after the dispute left almost a third of petrol stations with supply shortfalls. Japan has reopened its border today to vaccinated travellers from 68 countries, ending almost 3 years of pandemic restrictions. With a weak yen and relatively low inflation, hopes are high for a rebound in visitor numbers as airlines ramp up international flights. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Atkins, thank you. Now, Germany is coming around to backing the idea of joint EU debt issuance to help cushion the blow of the energy crisis. This is as long as the money is dispersed as loans. That's important, not grants, according to Bloomberg News, and that was a scoop. While details haven't been ironed out yet, the topic will likely come up in the discussions as EU leaders meet in Brussels next week. For more, we go to Maria Tadeo in Brussels. Maria, what exactly happened then? What do we know at this point in terms of the debate, how it unfolded, and the shift, this important shift from the Germans?
Well, Tom, this is a very active debate, and it has been for a week. Ever since the Eurogroup met last week on the Monday, Tuesday, it was obvious that something was cooking, that something is going on. Now, we should make it very clear, this plan that is being considered, explored, debated, however you want to call it, it's not a repeat of the 2020 Recovery Fund. That was huge. Remember, it was 750 billion euros. It was paid in grants and loans. In this case, we're not looking at grants. This would be loans. The difference here is essentially this is the bottom line of the issue that's being debated is that members of the EU have come around with, well, the reality that this winter crisis, they will need additional resources. The question is, at what funding rate do you get it? If you're an individual country, you go to the market, you may not be as well pleased as you could be if you do it as EU 27, backed by EU institutions with a AAA rating. So that is where the debate is at. And again, I should stress, this is very similar to what Bruno Le Maire told us last week. It's very similar to an op-ed that was put out by Paolo Gentiloni and Thierry Breton. A number of European officials putting this already out in the public debate for days. So this is a debate that is pending, it's ongoing, and as you alluded to, it will probably carry out all the way to next week when European leaders finally gather here in Brussels.
So, Maria, change of heart in Germany, of course, important, not definitive. Will there be enough consensus overall?
Yeah, and you make a very good point, Francine, because the German government itself has not really, well, commented on this or signaled that that's the way officially that they're heading into. But of course, as you know, politicians, they can say one thing in public and then be debating something behind the scenes. What I would stress, however, even if you get Germany on board, this is the EU. And as you know very well, Francine, you need unanimity for this. You need the 27 to agree to this. And yesterday, when I spoke to the Dutch finance minister, she was very clear to me that they, for themselves, do not really see the need for more tools. They say there's already enough money doing the rounds and it should be better employed instead of creating new instruments.
Maria, thank you so much. Our European correspondent, Maria Tadeo, there in Brussels. So let's take a look. Well, let's take a look. Do you like that? Let's take a look.
Take a look.
At gilts. I feel like I'm all over the place. A little bit like gilts because we have the third intervention from the Bank of England today, and yet there's a lot of concern of how the Bank of England has misfired. Again, the UK has run a deficit in its current account for a long time, and so if you look at the fiscal books, they have to balance it, or we won't rely on the kindness of strangers as much. So there's a couple of things in terms of liquidity that we think regulators are probably looking at, but also what does it take at this point for the Bank of England to be able to stabilize the gilts?
And I know I keep banging on about this, but I think the language from the Bank of England is pretty fascinating. They say, and I'm quoting, that dysfunction in this market and the prospect of self-reinforcing fire sale dynamics pose a material risk to UK financial stability. That quoting directly from the BOE statement, hence the intervention today, broadening that ban in terms of what they're adding in terms of gilts. And talking of gilts, there has been some money moving into the gilts on the back of this intervention. Yields are lower by 9 basis points on the 2-year at 4.29, the 10-year 4.41. That's a move lower by 6 basis points on the back of this intervention. We'll keep across these gilt markets for you. Coming up, Russia's strikes on Ukraine are widely condemned. As President Putin threatens to launch more missiles, we've got more context in that story next. The next steps possibly for the Russian president. This is Bloomberg.
appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Welcome back to the Open. 40 minutes into the European trading day, losses of 0.6% across the benchmark. The heaviest selling over in Italy, currently down by 1%. Here in the UK, the FTSE 100 off by 0.6%. Futures in the US also lower by 0.6% after 4 days of losses on US equities. Euro-dollar at 97 cents and the pound at 1.10. That is the shape of their play at 41 minutes into the trading day, Francine.
Now, our next guest, Tom, wants to create a more sustainable world by using green hydrogen to heat our homes and fuel our cars. It's a pretty bold approach that uses renewable electricity to split water into hydrogen and oxygen. It will form a key part of the debate at COP27 next month in Egypt. Well, we're delighted to be joined by Vatea Cohen, co-founder of Enapter, winner of the prestigious Earthshot Prize. Vatea, as always, thank you so much for coming on Bloomberg. Now, there are still a lot of questions about hydrogen, how you make it, and no hydrogen is actually created equal. But what's changed in terms of demand for electrolyzers, given fossil fuel prices have soared so much?
Yeah, absolutely. Well, thank you so much for having us. And I can say that the demand has only been booming, right? Because green hydrogen is an alternative to fossil fuels, and we need a clean gas, right? So every kilowatt hour of gas consumption that we reduce and instead are using green hydrogen for are reducing our energy prices. So we can see as an electrolyzer producer, the demand is growing. Absolutely.
What about the competition from China, for example, where electrolyzer companies are coming up thick and fast, and we know the ability for China to scale, and we saw that play out across the solar space, for example. How do you compete with those players?
Well, absolutely. It's a race, right? And so we believe that we have the sound strategy and the right technology to compete in this race. And we believe that the AM electrolyzer is a standardized modular system that can be scaled up fast in terms of production. So we're not afraid. We're ready for this.
What's your biggest concern, though, when you compete with China? So if you look at the solar panel, and there could be parallels, right? A lot of the solar panels are made in China. They're cheaper. I think 90% of them are made over there. How do you, in Europe, capitalize on your first mover advantage?
No, definitely. Great question. And I think, this is a team effort, right? So this is not just an Enapter against the world. I think this is really as a European coalition to really move forward in this. And I think there are some learnings in terms of what have we learned from the solar industry. And here, for example, at Enapter, what we do is that we make everything in our electrolyzers from A to Z. And so we understand the full process and know that nothing will hold us back, and we can keep moving fast in terms of our production and our scale up.
And talking of production, you have a factory in Germany. Have you started production at that factory? And if not, when will that happen?
So we just received the keys to the R&D building actually last Friday. So now we're moving in, and we will start the production early of 2023. So construction is on time, finishing the construction of the production hall as we speak.
How do you take on the huge industrial players? You have to be more nimble, or are there tricks to the trade?
Yeah, the industrial ones are, they're a completely different market, right? They really need to, let's say, be attracted to a lower cost of green hydrogen, right? So everything that we do is catered towards scaling fast and reducing the costs. So I think actually the trick with them is to start conversations early, right? Because they will not transition so quickly. And so we need to start those conversations now. And we're happy to already be in some projects, for example, where our electrolyzers are used for green ammonia. And they're scaling up in a very modular way because they see that they can quickly plug in our systems and increase their green ammonia production with a modular electrolyzer.
You talked about the costs, so I'm interested to know what is the lowest cost you can produce hydrogen at from the factory in Germany, for example?
Right. But the cost of green hydrogen depends on the cost of electricity, right? So there's not one single price point, and it really depends also on what the application is, whether it's industrial application or whether it is a commercial one. But we believe that with our megawatt scale electrolyzer, we will be cost competitive with gray hydrogen cost.
We're all getting ready for COP27. I know there's a lot of concern that actually either companies are scaling back or investors have less appetite for this, as you know, the world problems that we talk about day in, day out just seem to be mounting more and more. Are you frustrated by the slow progression of green things in Europe?
You know, I think COP is the only international platform that we have to have such conversations. So it's going to move at its pace. But yes, of course, I think that we need to do everything we can to move quickly and not defer action, especially not in terms of scaling up and deploying green hydrogen and green electricity in Europe.
How do you look at the US as a market? They pushed through the Inflation Reduction Act. Of course, a big component of that is subsidies and spending on green technology. Arguably, there's going to be increased competition then from American electrolyzer companies. But there's also a market you might look to play in. How do you think about that as a proposition?
Absolutely. Thanks for asking. So the US is super attractive right now, right? Because they've got this tax production cut of $3 per kilogram. So we're actually already active in the US in terms of creating this green ammonia, for example, but also in terms of providing green energy for disaster relief solutions. So we are already active in this market and believe that it'll be a booming market, especially because they're going big, right? We were just at a fair actually a couple of weeks ago, and they're just, we want to make green hydrogen. We'll figure out what it's for because we know that the demand for green hydrogen is there. And so we are going all in, and we believe in it.
Empowering ahead, no pun intended. Maybe yes. Wojciech, thank you so much for joining us as always. Wojciech Cohen there, co-founder of Enapter.
Okay, we talked about the US and the Inflation Reduction Act. Now to what is happening in terms of geopolitics. President Biden condemning what he calls the, quote, utter brutality of Russian missile strikes across Ukraine. That's as Vladimir Putin warns of more attacks. Several cities, including Kyiv, the capital, were hit by a barrage yesterday, killing at least 11 people and wounding over 60. The strikes came after Putin blamed Ukraine for an attack on the bridge linking Crimea to Russia. Let's get to Bloomberg's executive editor then for international government, Ross Mattison, who's been following all of this. Ross, would you categorize this, are the experts, the analysts categorizing this as a turning point in this conflict?
Well, it's really more a telling point than a turning point, potentially, because it does fit the pattern of what we've been seeing for some weeks now, which is that Vladimir Putin's forces are very much struggling on the ground. And as they get bogged down, and in fact, as they lose some of the territory that they had claimed and taken in the early months of the war, and certainly his initial goals of taking the whole of Ukraine quickly obviously failed, that he's becoming more and more desiring to sort of use infrastructure as a weapon going into winter in Europe. And we see that also more broadly with Europe, of course, with the energy crisis that is looming in many parts of Europe. But with Ukraine, particularly yesterday, with the infrastructure that was hit by missiles across multiple cities, not only civilians, of course, hurt in that or killed, but also electricity taken out. So what he's doing is trying to cause problems for Ukrainians going into winter, perhaps to wear them down as this war goes on and very much nears the 8-month mark, and to say, well, I'm going to persist no matter what, even if my troops are getting nowhere on the ground.
But what options does Vladimir Putin have left for us?
Well, that is the question. What is the off-ramp, if anything, for Vladimir Putin, or what can he do from here? I mean, obviously, there's a lot of discussion and really speculation about what might be, for want of a better word, the nuclear option. Is that still something that he might consider if he continues to fail on the ground? Does he desire to do some kind of tactical nuclear attack on Ukraine? Does he test a nuke on Russian territory somewhere to send a message? Does he try and go that far, or does he constrain himself at the moment to sort of further missile attacks in and around key cities? We can see that Zaporizhzhia was hit again today. He's been striking that for several weeks. And that is where the nuclear power plant, of course, is located.
And Ros, we heard pretty strong condemnation, as we'd expect from the Europeans, from the US as well. Beyond the rhetoric, the condemnation, is there a sign that they're going to be stepping up what has already been, of course, significant material support for Ukraine on the back of what we saw yesterday?
Well, certainly we're seeing that they're continuing financial support. At the moment, the Ukrainian government just needs money to keep functioning, to keep going with the war, but also the military support. There's been a lot of success sending in artillery, ammunition, and so on. But what the US and NATO allies have balked at is sending NATO standard weapons in, and that's really sort of fighter jets, modern tanks, and so on, and really the air cover that Volodymyr Zelensky said that he needs to repel the Russian forces. And the concern there is that if you provide really high-level artillery support, that you'll be engaging Russia effectively directly by NATO. And you can see that they're going to continue to say that they won't do that. So even though we'll see further calls today in that group of 7 conversation from Ukraine for those weapons, it's unlikely to come.
Okay, Bloomberg's executive editor for international government, Ros Mattison, walking us through the implications and the fallout from this barrage of attacks by Russia on Ukrainian cities. Thank you very much indeed. Coming up, a whopping $240 billion, $240 billion has been wiped off the market value of the global semiconductor sector. Further pain this morning across that space. We're going to break it down for you next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
Welcome back to the Open, everyone. We are 52 minutes into European trading day, and this is a picture overall for European stocks. So quite a lot of pressure, as again, we weigh the risk of inflation, certainly what's happening here in the UK with gilts. is also sending warning signs across the board. I know not a lot of people think that there's a crossover with how the BOE is trying to deal with gilts and what the Fed could do, but it just adds fuel to the fire of an ever more difficult market scenario going forward.
And let's do now more of a deep dive then on these markets and how they've moved and how they've adjusted in the first hour, almost first hour of trading here on this Tuesday morning. Let's bring in then the one and only Jan Patrick Barnett, of course, of Bloomberg. Jan, always good to speak to you about what's been happening. Just your take, the IMF, the World Bank, shock horror, warning of recession. How much gloom is there in these markets at this point?
Very good morning. Yeah, I would say a lot of gloom. And if you read through the top stories this morning, there's very little to get some confidence out there to build positive sentiment in equity markets. We have these macro warnings. We have the story from Ukraine where this terrible war signals that it probably goes rather longer than shorter. There's no change in sight. We have the chip rout going on. We have then the inflation number coming up, so that's uncertainty looming. So there's very little to build a bullish case for stocks at this moment from my point of view.
So another few days for tech and chip stocks. What's the way forward?
Well, that's super difficult. I mean, chips are like everywhere in our daily life, and the decline in demand shows you that the global economy is cooling down. And there's always the concern about like going into a recession. And it's also a big problem for Europe. We are lagging the growth and technology sector compared to the US, and the little bit that we do have is to a large degree directly or indirectly in the chip sector. So with that sector not doing well, it's also being another burden for the European stock market.
Jan Patrick, the BOE intervening again. Okay, gilts yields have come off just a little bit, not much, a couple of basis points, 2 basis points at the front end at 436 on the 2-year. What do you make of this intervention? They're warning of fire sale dynamics in these markets.
Yeah, I mean, they have no other choice than to do this. We know about the pension fund problem, that there are these long duration assets and that they're like in a massive trap here. So the Bank of England has to do something there. But we also know that like central bank intervention is probably good in the short term, but it creates a lot of problem in the long term. And we are now in this, like I would say, a little bit of a trap for central banks, that their actions, what they can do to calm down markets are very limited, given we have like more than a decade of ultra low interest rates.
But JP, if you're a central bank right now, how much angst do you try and intervene to try and support, for example, some of the bonds, or do you just let it go because it's part of a natural repricing?
Well, if I'm a central bank, I would have like a massive amount of angst, to be sure, because you don't know if your measures will work in the long term. Of course, they can't do nothing, so they have to do something to try to calm markets down. And then the short-term intervention in buying either bonds or supporting the currency is probably pretty much the only thing that they can do. But they're also very well aware that they can't do this indefinitely, and that when the market is wanting to go into one direction, they have to put up a lot of firepower to fight this, and this is a very dangerous path that that has a high probability, I would say, that you get even more into the corner. And what do you do then? So if I'm a central bank, I'm very concerned right now.
And it is often short-lived, isn't it? I don't know if it's the Jan Patrick Barnett effect, but currently you're seeing yields edging, well, you're down just by 1 basis point now on the front end here in the UK. And in fact, the selling has resumed at the 30-year level, just marginally. Jan Patrick Barnett, always fantastic. Thank you very much indeed. That is it for the European Market Open. Surveillance early edition is up next. Futures pointing lower in the US. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Inflation angst fears build over the impact of rising interest rates. Jamie Dimon and Nobel Prize winner Ben Bernanke join the chorus of caution. The BOE steps up its bond market intervention this morning. Parliament resumes today for the first time since Kwasi Kwarteng's mini-budget wreaked havoc on markets. Plus, Joe Biden pledges more military support for Ukraine as Vladimir Putin threatens more attacks. So first thing is first, let's check on the markets. Stocks fell, definitely pressured by rising treasury yields and signs that company earnings will not be as good as expected. We've seen already a couple of disappointments when it comes to earnings, certainly when it comes to chips, and also gauge of dollar, which we'll get to in a second, climbed to the highest this month. Now, European shares overall are down. We have S&P futures, also a bit of pressure, but if you look at the European stocks, they're also declining for a 5th straight session as bond yields jumping. Again, the persistently higher inflation is what people are concerned about, as well as the impact of hawkish central bank policies and global growth. Then watch out for gilts, the 30-year, look at that, 4666. The personal thing that people are worried about is, of course, the Bank of England will have to do a lot more. This is a third time that it intervenes on the markets, with now widening the scope of what it could buy. But the question of timeline is extremely important, as it's unlikely that the markets will like if they start QT later on this week. And then the other big question is, of course, do they need to continue buying bonds into that November 3rd Bank of England decision, and how aggressive will they be then? So I don't know if we have a European map. Maybe we do, maybe we don't. If we do, it's a good time to show it, and it's really a sea of red across the board, with the FTSE down 0.7%, FTSE MIB down 1.6%. So, as we were saying, global bonds selling off on fears that U.S. inflation numbers will bolster the Fed to continue hiking. Now, this, as the Fed's fight continues, the heads of the IMF and World Bank are also warning of a rising risk of a global recession.
There's the risk and the real danger of a world recession next year. The advanced economies are slowing in Europe. The debt levels for the developing countries are getting more and more burdensome. The rise in interest rates puts added weight on it. And inflation is still a major problem for everyone, but especially for the poor.
The risk of recession has gone up. The total amount that would be wiped out by the slowdown of the world economy is going to be, between now and 2026, $4 trillion. This is the size of Germany GDP gone.
Well, we're joined by Deirdre Cooper, portfolio manager at 91, and Christina Aquino from our markets team. So thank you both for joining us. Christine, let's start off with you. When you look at the anxiousness on the markets, it's again, when will the central banks pivot? And it doesn't look like they're ready to pivot yet at all.
Absolutely, Francine. At least when it comes to the Fed in terms of its tightening policy, we definitely see a lot of camps arguing out there, Goldman being one of them, saying that it really is too early, especially given the tightness in the labor market in the U.S. and the fact that inflation is probably still going to be sticky at these relatively high levels. We'll probably get confirmation of that, of course, this week with the U.S. CPI figures. And yeah, I think it really has been the priority of the Fed to tackle inflation. Although I would note that we do have Leo Brainard now starting to kind of sound out the potential impact, right, of a tighter Fed policy, how that flows through to the global economy in terms of weaker demand, and then how that in turn impacts the U.S. economy. She is, of course, a known dove, so not quite the consensus view, it doesn't seem like, at the Fed, but something to keep an eye out for.
Yeah, certainly to keep an eye on. Deirdre, overall, how much can the central bank support markets right now? And if they can't support them because they don't want to, or just it has to play out itself, what should traders be doing?
So I think we would agree. Our base case is absolutely that the Fed will stay the course. That means a choppy couple of months for markets. It also means our base case is a recessionary scenario. And what that means for us as active fundamental investors is that we have to find those companies that are more resilient, that have pricing power, and that can thrive, or at least, perform better through that very choppy environment.
That's hard, Deirdre. I mean, when you look at earnings, probably everyone will be tested. Where do you find that value?
No, that's exactly right. So we are going through all of our, company investments, looking at our forecast. We do see areas where companies are much more resilient. I think this is an unusual scenario where, certainly in Europe, you may have a high energy price recession. And that means that there are parts of the market, companies that are the solution providers for energy efficiency, perhaps other parts of the sustainability universe, companies that are providing increasingly cheaper alternative power sources to more expensive energy. All of those companies might perform quite differently in that recession.
When you look at some of the movements, not only in gilts, but in bonds overall, I mean, I don't know, it's impossible to find a floor, actually.
Yeah, it really does seem like that, doesn't it, Francine? I mean, the UK, of course, is its own very special case. Again, we have the Bank of England itself saying that it is afraid of the risk of a fire sale, its own words, in the UK bond market, and that's why it's stepping up its measures for a second day in a row. But more broadly speaking, I mean, it makes a lot of sense, right? The yields keep going higher as a lot of these central banks continue to telegraph more rate hikes. You do, of course, have camps now coming out and saying, well, actually, bonds are attractive. We know we've been talking about this, PIMCO, Bill Gross, among them. But again, it's a question of timing this particular trade, right? I think, it probably might make more sense if that trade comes through perhaps in 6 months when markets are expecting the Fed funds rate to hit its peak, at least it's based on current pricing, and then that might be really when that sort of bond bullish trade pays off. But at the moment, it really doesn't seem like, it feels like a pain trade, really, for a lot of these bulls.
Yeah, and I guess, Deirdre, the question is, why do markets not quite believe that central banks will be as aggressive as they say they will be?
Well, I think it really depends on where you are. I think markets generally, as I said, in the US, if those of us who are reading the Fed commentary, we believe that they will stay the course. I think in Europe and in the UK, it's a lot more difficult. Investors want credibility and visibility. I don't think you have either of those things at the moment here in the UK in terms of fiscal and monetary policy, and it's going to take time to regain that credibility and visibility.
Deirdre, thanks so much. Deirdre Cooper, their portfolio manager at 91, stays with us, and Christina Aquino from our markets team. Thank you as well. Coming up, the BOE widens its bond buying. Lawmakers return to Parliament later for the first time since Kwasi Kwarteng's mini-budget wreaked havoc. That's coming up next, and this is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away. The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blame. The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
I worry they haven't done enough, quite frankly. I mean, what we saw yesterday was an extraordinary move in gilts and ridiculous move in index-linked gilts. Yeah, you've got a real spiral here. I worry that this is not enough, and I think they're going to have to come up with their version of whatever it takes.
Well, Alan Higgins, Chief Investment Officer at Coutts, on the Bank of England's intervention in the gilt market. Now, the BOE expanded its bond buying after UK bonds sold off again yesterday, led by inflation-linked notes. The Chancellor, Kwasi Kwarteng, meanwhile, is set to present revised fiscal plans on October 31st. His second attempt follows a package of unfunded tax giveaways that sent markets into a tailspin last month. Now, joining us now is Dan Hansen, Bloomberg Economics senior UK economist. Dan, great to speak to you. When you look at what the Bank of England has been trying to do, so this is the third time that they've intervened or widened the scope of what they can do. How much more will they do to stabilize gilts?
Yeah, well, morning, Fran. I think that's a really interesting question because we've got this October the 14th deadline, Friday this week. And I think the bank's in a real bind because it keeps intervening and it's being very reactionary at the moment. And I think what markets are looking for is a little bit more certainty and a little bit more certainty beyond this October the 14th deadline. And I think, you know, if you're looking at it, it seems more likely than not there's going to be at least some sort of commitment from the bank to say, look, we're going to be here if we get another flare-up. And I think probably at the more extreme end is that they sort of back up and say, look, we're just going to stay in the market for longer. And as you mentioned there, give Kwasi Kwarteng time to set out his fiscal plan, which we know we're getting on October the 31st now.
But Dan, if you think they need to persist with the backstop, right, for another 2 weeks, maybe, you know, dovetailing into that November 3rd meeting, which is also the point that Van Ram is making on the blog today, then why do they not do it now? I feel like it's trickle, or third time intervening, and the markets are just testing that.
Yeah, and I think that's right. I think there's a really good question there about why they haven't decided to say, look, we're just going to stick this all the way out to the end of October. And I haven't got a good answer for why they aren't doing it, because it's very clear that the market is very jittery. There's a lot of uncertainty there. And I think, you know, they're just going to have to do something to bridge this gap. And fundamentally, it is a part about bridging the gap. Ultimately, this whole question about credibility and this broader question is on the government and it's on fiscal policy. So the bank has a role in this, but ultimately it's not going to be the answer. The answer lies with fiscal policy.
So, Dan, when you look at how much the Bank of England needs to raise rates by, I know the market's probably pricing in 100 basis points. Does that seem too much or too little?
So I think for the November meeting, there's a really strong argument for them going big. The big fiscal stimulus is essentially a free swing for them. And I think we're penciling in at least 100 basis points. What they'll be watching as well for this meeting, and what will be really important, is what Kwarteng says on October the 31st, and how much he offsets the fiscal easing of the tax cuts with spending cuts. What I think further out, though, is that the market's probably getting ahead of itself. We've got market pricing at around 5.75 or 6% here in the UK for the peak rate. I think that's too high. I think the bank's going to be very worried, probably when it gets to about 4%, which I think is likely. 4.5% seems like a reasonable bet for me. Once you get to that level, the bank's going to be very worried about recessionary dynamics and also about the impact of high rates on the housing market. We're already seeing the increase in mortgage rates and how that's affecting people's income. So I think those two things are going to stop it out a little bit lower than markets are currently expecting.
Dan, when you look at, of course, the fiscal spending, and we heard from the IFS, very respected institute, saying, look, they need to find 60 billion in funding, basically in austerity. The government needs, so it's now a choice between whether they go ahead with their plans and where they can save. Is that the kind of figure you're also looking at? I know that the situation changes every day, and we have some really great analysis at Bloomberg Economics.
Yeah, I mean, you're right. It does change every day. Every time interest rates change, the target changes because it changes the amount of debt interest the government has to pay out. But I think the IFS is about in the right ballpark. About £60 billion looks to put debt on a downward, the debt burden on a downward trajectory, a sustained downward trajectory. About £60 billion looks right to us. I mean, the challenge for Kwarteng is finding that. Of course, we've had austerity over the 2010s in the UK. It strips so much out of departmental budgets that he's going to have to look across departmental budgets. He's going to have to look across benefits, but also potentially across investment spending as well to make the sums add up. And even then, it looks like a stretch. So you can't help but feel that there's going to be a question around tax as well. Potentially not the tax cuts that were announced and reversals there and U-turns, but potentially tax increases elsewhere, because the scale of what needs to be found to make this add up is enormous.
Dan, thank you so much. Dan Hansen there, Senior UK Economist at Bloomberg Economics. Now we're back with Deirdre Cooper, Portfolio Manager at 91. Deirdre, I know we talked, big picture about the UK gilt market, but in general, what do you do with UK assets?
Look, I think I would absolutely agree with Dan. It's a very difficult situation here in the UK. But to your question, that doesn't mean that it's a difficult situation for every UK listed company. So there are lots of companies listed in the UK who really are global businesses who potentially benefit actually from a weaker pound. And we see some opportunity across our UK equity funds to invest in those companies at really attractive valuations.
I don't know whether, I know you also look very closely at sustainability, and there was maybe, 14, 18 months ago, there was a belief that the UK, because of its change in stature, could become the kind of green bond capital, certainly in Europe, if not of the world. Is that now taking a back step because of the more day-to-day crises that regulators are?
I think that's a really big risk. I think you're absolutely right. The UK was a leader, generally speaking, in building an economy to get to net zero. The UK was fantastic in terms of an early move into offshore wind, really is the market leader in terms of offshore wind. We talked earlier about how, from a fiscal and monetary perspective, we need more credibility and more visibility. We need exactly the same on energy policy. You can see the government at the moment thinking about renegotiating contracts for renewable energy. There's no visibility for investors in those markets, and that's going to damage the UK's journey to net zero, which is important for climate, but also really important for economic growth. We've seen what the US has done with the Inflation Reduction Act. We've seen how that's going to set the US on a pathway to lower energy costs and to more competitiveness. And we already see companies actually across our investment universe relocating manufacturing that was going to be in Europe back to the US because it's just a better place to be from a cost perspective.
But Deirdre, how do you explain this so that the government is not focused too much on net zero because they're trying to focus on other things? So there's maybe a reluctance, because we also heard, Jacob Rees-Mogg talking about fracking. So is there a reluctance to embrace what the previous government had done, or is it just that investors are no longer there because they worry about other things?
Investors are absolutely there. Investors are looking for places to put money to work that can be resilient through a recession, and the government needs to understand that.
Okay, Deirdre, thanks so much. Deirdre Cooper, our portfolio manager at 91. 1. Now, coming up, German Chancellor Olaf Scholz will reverse a long-held position and support the issuance of joint European Union debt to ease the energy crisis. We'll explain the significance of that move shortly. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away. The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blame. The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
When U.S. jobs numbers are released,
We come in almost bang on.
Bloomberg brings you crucial data at terminal speed.
If you're looking for 263,000, you've won.
And instant expert analysis.
Participation coming down too. Put it all together for us.
There's a slight disappointment relative to hope.
You can find anything if you're hawkish or dovish in this report. It's going to keep the Fed on track for a 75 basis point move at the next meeting.
This labor market is still pretty resilient.
Nobody covers Jobs Day like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
In light of elevated global economic and financial uncertainty, moving forward deliberately and in a data-dependent manner will enable us to learn how economic activity, employment, and inflation are adjusting to the cumulative tightening in order to inform our assessment of the path of the policy rate.
The Federal Reserve is committed to returning inflation to its 2% average goal. To do so, I expect we will need to raise rates further and then to hold that stance for a while. Of course, the exact path forward for policy will depend on the evolution of the economy and risks to the outlook.
Well, the federal vice chair, Lael Brainard, and Chicago Fed President Charles Evans on the rate outlook for the central banks. Now, we've been talking a lot about gilts. Of course, this is after what the Bank of England announced for the third time. At the very least, a lot of market participants say the Bank of England may need to persist with the backstop for another 2 weeks. That's according to our Van Ram. He has some great entry points also on the live blog. Remember, it's November 3rd that we have the BOE meeting. How much, how big a margin does the Bank of England need to raise by to make sure that the market get the right figure on inflation, the right message on inflation? So we also have some of the undue leverage. So we have a great story looking at some of the things that led us to where we are today on gilt. So you can see that 30-year 4.639. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Germany is open to the joint issuance of European Union debt to cushion the blow of the energy crisis. Chancellor Olaf Scholz signaled that the change in position on the sidelines of a summit in Prague last week, as long as the funds are paid out as loans, not grants. The move follows criticism that Germany's €200 billion energy aid could trigger imbalances in the bloc. Now, the heads of the IMF and World Bank are warning of a rising risk of a global recession. IMF Managing Director Kristalina Georgieva says higher interest rates are adding to debt pressures on developing nations. She says about a third of the world's economy will enter recession this year or next.
The risk of recession has gone up. The total amount that would be wiped out by the slowdown of the world economy is going to be between now and 2026, $4 trillion. This is the size of Germany, GDP gone.
Now, French drivers face more fuel shortages after unions vow to continue strikes at the country's biggest refineries. President Emmanuel Macron's government has been urged to mediate after the dispute left almost a third of petrol stations with supply shortfalls. And Japan has reopened its border today to vaccinated travelers from 68 countries, ending almost 3 years of pandemic restrictions. With a weak yen and relatively low inflation, hopes are high for a rebound in visitor numbers as airlines ramp up international flights. Reports have emerged of Iranian oil workers joining protests which have continued over the death of a 22-year-old woman last month in custody of the so-called morality police. Unverified social media videos show dozens of laborers and ununiformed workers marching. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. I have to say the rising of Rainy Moon is pretty incredible. Coming up, what will the metaverse truly look and feel like? We discuss all things virtual reality with Herman Narula, Chief Executive of Improbable. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Inflation angst fears build over the impact of rising interest rates. Jamie Dimon and Nobel Prize winner Ben Bernanke joined the chorus of caution. The BOE steps out its bond market intervention this morning. Parliament resumes today for the first time since Kwasi Kwarteng's mini-budget wreaked havoc on markets. Plus, Joe Biden pledges more military support for Ukraine as Vladimir Putin threatens more attacks on Ukraine. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So the Dutch finance minister says the European Union must ensure there is effective oversight of government plans to reduce debt. Sigrid Kaag spoke exclusively to Bloomberg's Maria Tadeo.
It is horrific. The indiscriminate shelling of innocent civilians, cities, constitute real violations, tangible violations of international law, humanitarian law, and I've heard the Commission already speak of war crimes. But our heart goes out to the people of Ukraine, and it's also very clear that their will not be broken, nor that of NATO or the European Union. We need to stand firm with Ukraine, particularly and even more so in the face of such cruelty and such war violations.
And when you say we need to stand firm with Ukraine, does it mean sanctions stay put? Maybe they go in crescendo? That support financially will also materialize, not just on weapons, but the cash they say they need?
Well, on all levels, politically, militarily, financially, the humanitarian support, there is one front. It's a European front and, of course, our NATO allies to make sure that the Ukrainian government and the Ukrainian people get what they need in order to withstand these atrocities.
And of course, as we reported today, what they want is air defense systems, and Russia also branded us a terrorist state. But going into the impact that this has to in Europe, because we can feel it pretty much every day in the cost of living, food crisis, inflation, energy bills. When you look at this blackmail in the hands of Russia, how do you respond to this economically? How can you alleviate some of the pressures if you can?
Well, we do need to alleviate. We do need to also invest, of course, and support our own citizens, particularly because it can't be that the outcome of this war will be that our population is suffering, that they feel there might be a loss of support for this righteous effort to support peace and security and international law standing by the people of Ukraine. So it can't be. So we need to make money available. We need to have the right support packages, as we have been doing, each country in their own way, but often in a coordinated manner, because our own populations also need to be able to get through winter, and the response to blackmail can never be that we give in.
And you mentioned the coordination, and that takes me perfectly to my next question. There has been, over the past week, a lot of debate in Europe about national measures are great, but not everyone has the same fiscal capacity. It's not a secret that Germany created a lot of tension with this 200 billion euro package, and there has been now calls that perhaps this merits new tools or a form of joint response. When you look at it from the Dutch perspective, how do you look at this?
Well, in all fairness, we've also recently announced a very generous additional package in support of households and small to medium-term enterprises. And it's a temporary set of interventions, as is desirable by, for instance, the ECB or the IMF. If you support, if you help, do it tangible, do it targeted, and make it time-bound. But I also acknowledge that, of course, the pockets of every country are different. The fiscal space for every country is different. But many countries have undertaken similar measures, sometimes earlier, and you can't compare them one-on-one. What we've been trying to do as ministers of finance, and of course also in the informal meeting in Prague, the prime ministers, to see what we can do together, where the means can be found, and how we can take a longer-term view, because this crisis will be with us for quite some time.
And the market, however, they're looking at potentially something that may not be a recovery fund, but may see, well, joint action or actions backed by the European Union's AAA rating. Is that something that you would contemplate?
Well, from the Netherlands so far, we've said there's a lot of money available in the different funds that we've created for other crises. I mean, and the Recovery Fund, Repower EU is a recent one that also accelerates the energy transition. There are billions and billions of funds available that have yet to be allocated. Let's look at that first, and let's see what our joint course of action will be. And at the same time, we always call for national government action where that's feasible. At the same time, we need to look towards debt sustainability, not just of our own country, but of the Eurozone as a whole.
Let's get straight to your Bloomberg Business Flash now with Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned the UK is pushing ahead with plans to set a cap on the revenues of renewable power producers. Government officials held talks yesterday with energy companies on a mechanism similar to the one proposed in the EU. The move would limit revenues and channels the funds to help struggling consumers. Now, Rivian shares have tumbled after the EV maker said it would recall nearly all the cars it delivered after discovering a minor structural defect. The US company says while the issue was only found in 7 vehicles, it's recalling about 13,000. Rivian only recently overcame production problems and parts shortages. And London's most expensive home is up for sale again. Bloomberg has learned the chairman of embattled Chinese real estate giant Evergrande has put the Knightsbridge mansion back on the market. The 45-bedroom property overlooking Hyde Park was snapped up for £210 million in April 2020. And that's your Bloomberg Business Flash. Francine.
I really dread to think of electricity and gas bills come the winter, but I know I'm not who they're marketing to. Leanne, coming up, Russia's strikes on Ukraine are widely condemned as President Putin threatens to launch more missiles. We have the full story on next. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francie Lacqua here in London. Now, Facebook parent company Meta has made a number of acquisitions to bolster its offering in virtual and augmented reality. The chief executive, Mark Zuckerberg, has said he wanted the company to popularize the metaverse, a more immersive version of the internet. However, my next guest believes that Meta's vision is misleading. In his new book, Virtual Society, there is the book. He argues that Mark Zuckerberg's company will not be the sole owner of the metaverse. Well, we're delighted to be joined by Herman Narula, chief executive and co-founder of Improbable. Last time we spoke, you were talking about the book, and now it's out, so congratulations on that, Herman. Overall, there was a lot of buzz on the metaverse. I wonder whether every day we talk about inflation, cost-cutting, the cost of living crisis, and whether that's making a lot of the big companies less likely to spend millions, if not billions, in trying to work on the metaverse.
I think for those working on the metaverse, yeah. But for those that are actually looking to create content within the world, it's the opposite. If you're a major sports league today, your attendance is going to be down in the context of people not being able to afford tickets or to travel. So the metaverse offers new opportunities for you to engage your audience at a much more cost-effective basis.
But do you think it will be taken more years because of the cost of living crisis?
I think it's already happening. Outside of Facebook, which gets all the attention, there are so many companies that are already making breakthroughs in everything from the economics of the metaverse through blockchain and Web3, through technology like ours to handle large scale. So I think it's happening with or without that investment at this stage.
And I know in the book you also argue that, look, the usual definitions of metaverse are, confusing at best, unconvincing at worst. I mean, they are pretty vague. How would you describe the metaverse? And if you're like an advisor to Coca-Cola right now, how do you tell them to get in?
I'd say the metaverse is simply this. It's a network of meaning that connects together different socially constructed realities. So it's really a way for something that happens in the world of sport or fashion to impact the real world or to impact a virtual space. It's a network of interconnected identities, objects, and interactions. So if you're a brand, then the metaverse is the ultimate way for you to engage with your audience because you can create embodied interactions where thousands of people could hang out with you, celebrities, the brand, and even engage in experiences that wouldn't normally be possible. So I would say it's about discovering a new skill, just like the origin of the internet kind of caused these brands to think differently about how they engage with people.
Herman, I guess the only setback is that it could take a lot longer if you don't have someone like Google or Facebook fully behind it because of the infrastructure, right? It's a little bit like EVs. If you don't have the right infrastructure, then you're not going to reach the client as quickly and as most powerful as possible.
I think that's a misconception. Earlier this year, we ran events with thousands of people hanging out in the metaverse, and it cost us less than $100 an hour to run these events with 15,000 people in them. So it doesn't take VR headsets and extremely expensive infrastructure to build vastly complex worlds. I think Facebook is looking in the wrong place.
But this is what, 0.1% of the population that have so far experienced it, and how long do you think how big do you think it'll become?
Well, the games industry is already more than 3 billion people. Yeah. So if you look at the metaverse as VR, then yeah, of course it's a niche. Yeah. But if you look at the metaverse as something you're going to access from your phone, from TV, from every possible device, interacting with these interesting virtual worlds, we already have the infrastructure. We've already got game engines. We've already got the networking technology. So I think it's a matter of time and not that long before we start to see experiences that touch people in their everyday lives.
I know we talked about this last time, first mover advantage. I don't know whether that's changed in terms of winners and losers.
I think that this isn't going to be a market that is won by one centralized company. It's going to be won by a network, and I think that network is going to be rooted in blockchain and Web3 and in the idea of sharing value between businesses. That's a very new concept, and it's not something existing behemoths are well set up to take advantage of. So I don't know that it's going to look like the last disruption in terms of in terms of what guarantees victory.
But do you see, I mean, I mentioned Coca-Cola, I could have mentioned a number of other big players. Do you see their commitment increasing to the metaverse or scaling back?
Oh, absolutely increasing. I mean, it was recently announced that we're going to be profitable for the first time in my history. That's entirely based on companies making investments in building metaverses in virtual worlds with a 2-year, 3-year time horizon. You know, these are brands in fashion, in music, in film. And I see a clear gulf between those that are investing now and are going to have the advantage of having built and calibrated really effective experiences, and those that are going to be latecomers and are going to be left behind.
And you don't think, I mean, again, you know, in our world, we talk about earnings and we talk about the concern that inflation will erode a lot of the margins for a lot of these big companies. You don't think that will have an impact on spending?
Games tend to be recession-proof because they're the cheapest form of entertainment. On a per-hour basis, games give you more activity for less dollars spent. You can do them from home. You can do them from anywhere in the world. You can interact without necessarily needing to travel. So in the last recession, video games actually did reasonably well. Yeah. I personally think virtual experiences, especially as people start working from home as well, are going to become a much, much more effective use of capital. And I think a poor economy will only help it.
Can Europe really rival China in some of the innovation in this space?
Sure. I think, sorry, could you repeat the question there?
So can Europe rival China? We know China is doing quite a lot in this space. They do it cheaper, they have more data access, and can get things quicker.
So as I argue a lot in the book, the value of the metaverse comes from deep, rich social experiences and self-expression. Those are pretty counter to the rules of building content in China. While China has a lot of advantages in terms of its tech companies and its investment, its desire for control over the experiences actually runs counter to building valuable experiences. Also, the content, the brands, the opportunities, the communities that are necessary to flourish, for the metaverse to flourish, I don't see them existing within that system.
All right, Herman, so interesting. Thanks so much. And again, congratulations on the book. Herman Narula, their Chief Executive Officer and co-founder of Improbable, with the book just out. Now, let's also talk about geopolitics and foreign affairs. U.S. President Biden has condemned what he calls the utter brutality of Russian missile strikes across Ukraine, as Vladimir Putin warns of more attacks. While several cities, including Kyiv, were hit by a barrage yesterday, killing at least 11 people and wounding over 60. The strikes came after Putin blamed Ukraine for an attack on the bridge linking Crimea to Russia. Let's get straight to Bloomberg's executive editor for international government, Roz Matheson. So, Roz, is this actually a turning point in the war?
Well, if anything, it's just another sign of the darker turn that this conflict is taking, if that's possible, as a Russian President Vladimir Putin's troops really struggle on the ground. They're being backed out of parts of eastern Ukraine. They're struggling in southern Ukraine. And you can see that combined with the attack that happened on the weekend on that bridge to Crimea, a real prestige blow to Vladimir Putin and the pressure he's getting from hardliners at home. We can see the chorus growing on that. That suggests that he doesn't have a lot of options, that this is a moment where he's decided to dig in no matter what. He's decided that he's there. He needs to have some kind of outcome from this war that he can say that he gained something from it. And so, if anything, he's digging in. And that's heading us into a very difficult winter, obviously. And this move to target infrastructure by hitting multiple cities yesterday, the message was, we can still hit you no matter where you are, in the far west of Ukraine, in the south of Ukraine. We have weapons and missiles that will find you. We're going to target civilians. We're going to target infrastructure. We're going to make life very difficult for people in Ukraine in the next couple of months.
Thank you so much. Roz Matheson there with the very latest, of course, on what's happening in Ukraine and Russia. She's executive editor for government coverage. Now, coming up, how one city's policy is changing the makeup of its cars. We'll discuss today's big take on London's EV boom. That's coming up next, and this is Bloomberg.
started, I had no idea it was going to turn into this. This is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it.
You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual.
I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany is coming around to backing the idea of joint EU debt issuance to help cushion the blow of the energy crisis. This is as long as the money is dispersed as loans, not grants, and that's according to a Bloomberg News scoop. Now, while details have not been ironed out yet, the topic will likely come up in the discussions as EU leaders meet in Brussels next week. Now, for more, we're joined by Maria Tadeo in Brussels. So, Maria, what exactly is being debated? And good morning.
Yeah. Good morning to you too, Francine. And you made out what is a critical difference here. I think you explained it very well. This is about the loans, it's not the grants. So in other words, it's not a rerun of the recovery fund. This won't be a recovery fund 2.0. That was 750 billion euros back in 2020. Remember, the amount was split. Some was grants, the other was loans. The idea here, however, is that you could see European institutions tap markets that is AAA rated and then get the funding and distribute that to member states that are now crystal clear they will need additional help to deal with the winter crisis. The core issue, and this is fundamentally the thinking behind this, is that if you tap the market as EU27, you'll get a better funding rate than you would if you're, let's say, a peripheral country going out to the markets by yourself. So that's where the debate is at. But I should note, however, this is something that would have to be presumably agreed by the EU27 unanimously. And it's clear that we're not there yet. We just played an interview with the Dutch finance minister, which she said it very openly. She does not see the need for new tools to deal with this crisis.
So, Maria, a change of course of heart in Germany is very important, but not definitive. So will there be enough consensus?
Yeah, and it's not definitive. And again, I should also note that the German government has not made this position official. This is a story that broke yesterday on the Bloomberg, citing a number of sources, but officially Olaf Scholz has not said this on the record. But the choreography now, Francine, from now until next week will be that today energy ministers will meet. At one point, the Commission will come up with a plan of action that may or may not include this. That will be a key point. And then it's up to European leaders next week on October 20th and 21st to really figure out what type of response they're going to put up with this energy crisis and what type of consensus they can build around some of the measures that are being floated pretty much every day, I should say, in Brussels. This is a very active debate here.
Yeah, certainly is, and of course, I mean, a lot of traders were, forwarding that Bloomberg scoop yesterday because it's definitely a game changer potentially. European correspondent Maria Tadeo in Brussels for us. Now, London's polluted air turned the city into an electric vehicle pioneer. Today's Big Take explains that in a bid to tackle the capital's traffic congestion, the city introduced some of the toughest restrictions on heavily polluting cars. Now, the policies almost flipped a switch on the adoption of electric vehicles. Now, let's bring in Bloomberg's Craig Trudell for more on the story. Craig, I'm really happy to speak to you about this because over the last 3 weeks, there's such bad news coming out of the UK, if I'm 100% honest, that this is actually a feel-good news. So what are some of the conversations that you've been having about the impact it's had for EV?
Yeah, for me, this really started a few months ago when Uber was eager to talk about why they were having such great progress in the fleet in the city of London turning over. And it was a lot of companies want to tell a feel-good story about how things are improving within their operations, but this one really stuck out to me because of the sort of long and tumultuous history of Uber in London. There's been a lot of tension between the mayor's office and this company, but the company really spoke effusively about this idea that road pricing policies was a huge distinguishing factor and sort of a driving force in why electric vehicles were having so much more success on the platform. You don't necessarily have a big difference in terms of incentives. The charging infrastructure is coming along, but it isn't necessarily way ahead of other places. The reason why London has had such success in drivers going out and getting electric vehicles is it really costs a lot to drive in the city every day unless you're driving an EV now.
Yeah. So is it a prescription that other parts of the world and other metropolises can emulate?
Yeah, there's absolutely going to be an effort to replicate this elsewhere. Even in New York City, there's been a lot of talk about that and not necessarily a lot of follow through, but we've been sort of assured that this is going to be tried again in New York City. The idea that a company like Uber, where you wouldn't necessarily think that this policy would be in their business interests, the idea that they've come forward and talk about, the fact that this has been, such a big driving force, and then being able to achieve their sustainability goals does give you some hope that maybe some other cities will try this out because they're getting they're seeing the results from the City of London and also perhaps getting some pressure from, the private sector and companies like Uber.
I was in Amsterdam yesterday and actually was in a Tesla. It was a taxi. It's always a bit fiddly because you don't know how to open the door.
Yes.
You always feel a bit dumb, but then you feel like you're doing something for the environment.
Yeah, you're actually, we're hearing about that now that there's a big push with Uber actually in the U.S. with more Hertz cars that are Teslas. A lot of people, walking up to their Uber and having trouble getting into the door. It's interesting.
It's a real thing. There
Yes.
you go. It's not just blonde Francine. Craig, thank you so much.
Thanks.
Craig Trudell there, of course, our European car czar. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Katie Lyons in New York, or Anna Edwards is here in London. I know they'll spend a lot of time talking about the markets. They'll also spend a lot of time looking and hearing about this BOE intervention. We just heard from Neil Wilson, for example, great analysis on what it means for the Bank of England today, widening its gilts market intervention to counter what it says is a material risk to the UK financial stability. So the BOE now including index-linked gilts in the basket of assets it purchased as part of the intervention in the wake of the Chancellor's mini-budget. But will they have to go a step further? That's really a critical question for today. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
Powell has now endorsed the notion that there is going to be some pain involved.
This is an environment where the bond market vigilantes are back.
You probably don't want to be the one, validating market expectations of the recession. You probably don't want to add to the general bleakness in the system.
I think there's worse to come for the market, unfortunately.
The biggest concern with the dollar is what it's requiring other central banks to do in terms of tightening when their own economies are looking to head into potentially severe recessions, and then a financial accident.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. More intervention. The Bank of England adds inflation-linked bonds to its purchases to stabilise the market and avoid what it calls fire sale dynamics. Broader gilt yields have been dropping after yesterday's climb. A $240 billion wipeout. Chipmaker stocks slumped in Asia, hurt by continued fallout from the fresh US curbs on China's access to technology. And a Bloomberg scoop, Germany's Chancellor Olaf Scholz makes a shift. He's now supporting joint EU debt issuance with conditions to cushion the blow of the energy crisis. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, another day, another intervention from the Bank of England and risk aversion to the fore, it seems, here in Europe.
Yeah, and that was definitely the case in Asia overnight, and a lot of it driven from that semiconductor story you were just mentioning, Anna. A lot of pain for the chip stocks out there. And as you had markets like Taiwan, South Korea, and Japan opening up after holidays on Monday, they were catching up to some of those real losses we have seen over the last day or so. Taiwan's benchmark stock index down about 4.4%, the worst day since March of 2020, now at its lowest level since November of that year. And of course, a lot of that had to do with Taiwan semiconductor, down a record 8.3% overnight. Really speaks to the chip pain that is out there. And that is filtering through to foreign exchange as well, both the Taiwanese dollar in Asia as well as the South Korean won, as you had the likes of Samsung lagging on the day too, are under pressure. The South Korean won actually won at 14.35 to the dollar. That is relatively weak, not quite at the weakest levels we have seen so far this year, but still we're getting close back up to that point. And of course, in the bond market, we have seen a lot of selling pressure in global bonds around the world, and that definitely was true in the Asia-Pacific region, including in Australia, where that 10-year yield rose 17 basis points to 4.03%, Matt.
All right, well, we're seeing big yields here as well in the U.S. First off, futures are down another 0.8%. So it looks like we could come back under 3,600 this morning. And then we're seeing the 10-year yield up at almost 4%. It's at 394.09 right now, but pushing up against that level. The 2-year yield at its highest level since 2007 at more than 431 right now. NYMEX crude trading TI at 88.74 a barrel. So it's come off a little bit on concerns that demand will drop in a recession, and Bitcoin is down 0.7%, but still hanging around the same trading band where we've seen it, 19,108. Can anything knock Bitcoin off of this, out of this range? It doesn't seem like anything has over the last few weeks, at least. Anna, what do you see in Europe?
Yeah, we'll get to another Bitcoin conversation, another wider crypto conversation later in the program, won't we, Matt? In Europe, I see red, plenty of red, negativity across European equity markets. The London market weighed down by its emphasis on energy stocks and basic resources. And with that in mind, I'll show you what I've picked out to talk about here on the European space right now. There is a concern around growth today, and as a result, basic resource stocks down by 2.5%. It's the same concern around growth weighing on Brent crude, 93.83, despite the fact we saw OPEC, of course, deciding to cut back on production. That was last week's story. Today, the growth concerns seem to be dominating, at least today. Now, here is where a lot of the interest is, a lot of the action is, and I mean broadly in the UK gilt market. What we have seen today is the Bank of England widening what it's going to do this week in terms of buying up gilt assets, adding inflation-linked gilts. We'll get more detail on this from Danny Berger in just a moment, but I just wanted to flag what's going on with the crucial 30-year gilt yield, because we talked about this yesterday being just above 4.5. We then saw all across the UK curve, we saw those gilt yields rise yesterday. Today, the action from the Bank of England did seem to be enough to bring the gilt yields down in the very short term, but not now at the 30-year. That's where we're seeing the 30-year behave a little bit differently and just trying to move in the other direction. Now, Credit Suisse also in focus today, up by 1.7%. Goldman Sachs analysts then, Matt, trying to put a figure, a number on the amount of capital that this business needs to raise. We'll wait till October 27th. But in the meantime, Goldman Sachs saying they need 8 billion Swiss francs. That's around $8 billion US.
Yeah, and we're hearing other analysts as well say they need that much or even more, right? 9 billion has been called at another shop. So watch closely Credit Suisse shares today. Let's get more, though, on the BOE as it expanded its emergency measures to tackle chaos in the bond market, broadened out the scope with linkers now added. Alan Higgins, CIO at Coutts, spoke earlier on Bloomberg.
I worry they haven't done enough, quite frankly. I mean, what we saw yesterday was an extraordinary move in gilts and ridiculous move in index-linked gilts. Yeah, you've got a real spiral here. I worry that this is not enough, and I think they're going to have to come up with their version of whatever it takes.
Bloomberg's Danny Berger joins us now for more. So make or break for the Bank of England, says Alan Higgins.
Yeah, I mean, it's just a Bank of England here whose sole purpose at this moment at least, is making sure this is not a dysfunctional market. It is monetary policy for the sake of stability. And here's the ridiculous move, as Alan Higgins put it for our radio listening audience. It's the daily move in those linkers, those 10-year UK inflation-linked bonds, moving 64 basis points yesterday, a record move. That is not something that can be explained by fundamentals. This is a market that is extremely tense, considering the Bank of England didn't have linkers in its purchase program previously. So the market is testing it, and of course, those now infamous LDIs, they hold a lot of these linkers. So the deleveraging continues. And throughout the Bank of England statement and the notes attached to this statement, it keeps saying stability over and over again. They wrote dysfunction in this market and the prospect of self-reinforcing fire sale dynamics pose a material risk to UK financial stability. But this brings it back around to Alan Higgins' point. Is it enough? Look, the bond market is calm today in the UK, but it is noteworthy that we are seeing the long end of the curve. Some of those gains are starting to peter out. We're not even down 1 basis point. Yes, belly of the curve is seeing some bids. So the fundamental problem remains, Kaylee. It is a market concerned whether these pensions have deleveraged enough, considering they didn't take the BOE up on many of their purchases, and a market that is testing the central bank, considering these moves are really against what their aim is to bring inflation down.
Dare we say vigilantes. Bloomberg's Danny Berger, thank you so much. Now let's turn to the chip space. A whopping $240 billion has been wiped off the market value of the global semiconductor sector. Chip-related stocks in Asia have plunged after the Biden administration imposed curbs on China's access to semiconductor technology. Bloomberg's Tom McKenzie is joining us now with more. Tom, this is absolutely brutal. And of course, it's not just a matter of the Biden administration's moves. The earnings picture and demand picture for these companies is also not looking good.
It's looking bleak, isn't it, Kelly? Look, you touched on some of the key points at the top of the show. Of course, some of these markets, as you say, waking up after national holidays, and so you see that route as they digest the news from the US. Of course, there's more than 100-page document that came out of Washington on Friday. So you saw that impact on the likes of TSMC over in Taiwan. You saw that impact on Samsung. TSMC ending the session down by more than 8%, and across the industry, 240 billion. And then you mentioned this as well, the ripple across to the currencies, because the importance of the chip-making industry and that sector to the economies of Taiwan and Korea in particular. There was a read across also to the chip makers and the producers of some of these ultraviolet lithography machines, particularly ASML here in Europe. That is lower the last time I checked. ST Micro over in France and Infineon Germany also taking a hit. Morningstar, the analysts there saying, look, there are going to be more uncertainties for this sector. To your point, it's not just the restrictions put in place by the Biden administration, it's also the fact that there is now very weak demand for consumer electronics. So that's a further drag. China's response is also something we're watching for.
All right, Tom, thanks very much for that. Bloomberg's Tom McKenzie there talking to us about what's going on in China with chip stocks. Really, it's a global issue. President Biden, on another issue, has condemned what he calls the utter brutality of Russian missile strikes across Ukraine, as Vladimir Putin warns of more attacks. In a call with Ukrainian President Volodymyr Zelensky, Biden says the U.S. would continue providing Ukraine the support it needs, including advanced air defense systems. Meanwhile, on the energy front, Germany is coming back around to the idea of backing joint EU debt issuance to help cushion the blow of the energy crisis. This is as long as the money is dispersed to other countries as loans, not as grants or giveaways, according to a Bloomberg News scoop. While details have not been ironed out just yet, the topic will likely come up at the discussions as EU leaders meet in Brussels next week. Let's get to our European correspondent, Maria Tadeo, in Brussels for more. So, Maria, what are we talking about here? More EU shared debt.
Yeah, but Matt, this is critical to get the nuance here. And in fact, it has been in the public debate now for a week. Last week on the Monday, Tuesday, when the Eurogroup was meeting in Luxembourg, and I covered that meeting, to me, it became obvious that something behind the scenes was cooking. And what you have here is potentially now an opening that would see joint debt, but this is not a replay of the Recovery Fund 2.0. This is not going to be the same thing. Remember, at the time, this was the pandemic, and this was a huge mega fund that was funded by the EU. It had grants and loans. The idea here is that facing this energy crisis, it has become obvious that member states of the EU will need additional funding and additional resources, and the key is at what rate. Now, some countries are suggesting it's better to do it as EU 27. You will get a better rate in the market, especially if you compare it to peripheral countries that may find it difficult to do that by themselves. Now, what the Germans are suggesting is that this is something they could explore, but I would note also one thing. If Germany opens up, you get political momentum going into this, but you also need to factor this is a decision that will have to be agreed unanimously by the EU 27, as it always gets done. And yesterday, when I spoke to the Dutch finance minister, she frankly wasn't so keen. So this is still a story that is to be played.
Okay, so different to the fund that we saw put in place during COVID, a bit more similar to the Shaw program that predated it then, yes. Maria. So a change of heart, some evidence of a change of heart in Germany. That does seem important, but is there enough consensus around that?
Yes, Anna, it's not the recovery fund, it's the Shore. I was trying to avoid the technicalities, but you beat it to me, and yes, that's exactly what it is. This was a program that preceded the recovery fund, which was in many ways eclipsed by the magnitude of this fund. But, you know, in terms of the choreography going forward, to answer your question, I think things will have to move in the next 2 weeks. The Commission has been given a deadline to come up with a plan to deal with the escalating cost of the energy crisis. Energy ministers are meeting today. At one point, this plan will have to be presented to the different nations of the EU, and then we're expecting, remember, this is what we heard from the French president last week, come October 20th and 21st, this is decision time. There has got to be something on the table that they're able to make a joint decision. So really, this is 2 weeks where I predict there's going to be a lot of back and forth between Brussels, Paris, Berlin, and the different capitals.
All right, the clock is ticking, and we trust that you'll be there for us reporting on every single move. Bloomberg's Maria Tadeo in Brussels. Thank you so much. Now let's get back to the equity markets and take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with Las Vegas Sands, which saw a pretty sizable down day yesterday, down about 7.5% after data showed that Golden Week in China in terms of tourism was pretty disappointing, and that doesn't have great implications for the gambling enclave Macau, where Las Vegas Sands gets more than 60% of its revenue. So after the big declines of yesterday, we are seeing those losses continuing this morning, down about 3.4% before the bell. Now, we also are seeing a lot of commodities moving south too, including oil, and that is weighing on energy names in early hours, the likes of ExxonMobil down about 1.8%. And then finally, to bring it back to the semiconductor story we were just discussing with Tom McKenzie, of course, the pain not limited to Asia. It was felt here in the U.S. over the last several days. NVIDIA, the big large cap U.S. chip maker, down 11% in the last 2 sessions, and those losses continuing this morning, down about 1.5% before the bell, Anna.
Kaylee, we will get back to the conversation around bond markets shortly. We'll talk to Nicola Mai, PIMCO portfolio manager and sovereign credit analyst, a great guest to talk to. A day after we saw the biggest ever surge higher in inflation-linked gilt yield, the Bank of England stepping into the market today. Across the regular gilt curve, we see a bit of calm, but maybe not quite at the long end. We'll get the views of Nicola Mai shortly. Anthony Trenchard also joins us, Nexo co-founder. We'll talk about the state of crypto as we head deeper into a winter, perhaps. Plus, how London's polluted air turned the city into an electric vehicle pioneer. Read more in today's Big Take story on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Tomorrow, Bloomberg has the biggest names in business. Bloomberg Invest New York, where industry leaders discuss the challenges and opportunities in today's changing economic landscape. Coverage begins tomorrow, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kaylee Lyons here in New York, Anna Edwards with us out of London. We are seeing liquidity worsen pretty much everywhere, but it's very bad in the UK, which those of you watching on TV can see here in blue, and in Italy, which you can see in yellow. Those of you listening on radio, just take my word for it. Or when you get to your Bloomberg terminal, type #BTV 4289 to see this chart. Now, Ksenia Galuchko joins us right now, Bloomberg Equities editor, to talk about what this lack of bond market liquidity is going to mean for the equity market. So far, it's not been good news, Ksenia.
That's right. It's been another dramatic day in UK markets, with the Bank of England coming out with another support measure and being willing to buy up those inflation-linked gilts. Again, right now they've managed to stabilize the market after this major sell-off on Monday. But again, the deadline for the expiration of their bond buying program is this Friday, so we might see more volatility around that. And although I'm focusing on the bond market right now, of course there's repercussions for the broader financial markets in the UK and equities also. Of course, the FTSE 100 does benefit from the weaker pound, but the FTSE 250, the mid-cap, the more domestically focused index, remains under pressure.
Okay, and Ksenia, good morning. So that's the bond markets, the read across into equities. I'm looking at a headline here that says earnings are looking bad, but what's coming could be even worse. Sounds gloomy. Explain.
Oh my God, yes. So strategists are quite spooked about the upcoming earnings season. They say that the third quarter earnings no longer matter because it's all about the guidance for the companies. So they're going to be looking out for those warnings. We've got many problems in place. We've got surging inflation, labor costs, supply constraints, margin pressures. All of these things are going to come in play, and the earnings season kicks off this Friday with JP Morgan, Citibank, and we will see how things go. This could put more pressure on the equity market, which is already struggling quite a bit, with the S&P 500 poised to hit possibly another November 2020 low this week.
Well, before we can get to JP Morgan on Friday, though, Ksenia, we have to get through inflation data on Thursday, which is going to be crucial in terms of how this market is thinking about Federal Reserve policy. What could it mean for the policy pivot narrative that Goldman Sachs says it's too early for?
Absolutely, yes. And Goldman and other strategists are warning that this whole pivot narrative that did drive a recovery in the summer and also in the early days of October is going to be flawed. And inflation is likely to come in high again, possibly higher than expectations even, because we have seen oil prices come up recently because of the OPEC deal that did drive up the oil prices. So inflation is going to stay sticky for now. And in general, with the labor market remaining very robust, as we saw from data on Friday, the Fed is unlikely to pivot. And I think Powell has been very clear in his message that they're going to stay on their hawkish path.
Okay, Ksenia, thank you very much. Bloomberg's Ksenia Galuchko with the latest on markets. And for more market analysis, check out MLIV Go, the function to use on your Bloomberg terminal to find the Markets Live blog. This is Bloomberg.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
When I started, I had no idea it was going to turn into this. This is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. More allegations in the Elon Musk Twitter battle. Bloomberg has learned that just before the billionaire revived his proposal to buy the social media company, he accused Twitter of ordering a whistleblower to destroy evidence. According to court filings, Piotr Zatko said he burned 10 handwritten notebooks and deleted 100 computer files at the request of managers as part of a $7.8 million severance package. Japan has reopened its border today to vaccinated travelers from 68 countries, ending almost 3 years of pandemic restrictions. With a weak yen and relatively low inflation, hopes are high for a rebound in visitor numbers as airlines ramp up international flights. Meanwhile, the Chinese Communist Party's flagship newspaper endorsed the country's COVID-0 policy for a second day in a row, dousing hopes that President Xi Jinping will relax controls soon after a key political meeting later this week. The report calls the policy, quote, sustainable, and says the country must stick to the strategy because it's key to stabilizing the economy and protecting lives. And the heads of the IMF and World Bank are warning of rising risk of a global recession. IMF Managing Director Kristalina Georgieva says higher interest rates are adding to debt pressures on developing nations. She says about a third of the world economy will enter recession this year or next. And it speaks to the policy dilemma for both monetary and fiscal policymakers, Matt, in that inflation is the problem everyone was first focused on. The policies you use to fight inflation are going to mean a hit to growth.
Yeah, absolutely. And I mean, the idea is they should have been using these policies earlier, then they wouldn't have had to use such heavy, blunt tools to fight inflation. But now it's too late, and the only thing they can do is cause a recession in order to end inflation.
Yes, and we heard Jamie Dimon adding his voice to those gloomy calls, and Ben Bernanke, both voices cautioning about what we need to watch out for as the global economy slows down. I spoke to Alan Higgins. We heard a little bit from him earlier on in the program. I spoke to him in earlier programming here in Europe from Coutts & Co, and he was saying, yes, he's concerned about these global forecasts of doom, but also that markets have been well aware of this for some time, and that perhaps the market narrative is a little bit ahead of that, and we're still looking for that pivot. Say it quietly. I know we're not supposed to say that word too loud these days. Right, Nicola Mai joins us shortly. shortly. PIMCO portfolio manager and sovereign credit analyst. Great voice to have on the program today as we look at what's been happening with gilt yields really rising yesterday, coming down a little today. The Bank of England expanding its bond buying program. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. More intervention. The BOE adds inflation-linked bonds to its purchases to stabilize the market and avoid what it calls fire sale dynamics. Broader gilt yields drop after yesterday's climb. A $240 billion wipeout. Chip makers' stocks slumped in Asia, hurt by continued fallout from the fresh US curbs on China's access to technology. And a Bloomberg scoop. Germany's Chancellor Olaf Scholz makes a shift. He's now supporting joint EU debt issuance with conditions to cushion the blow of the energy crisis. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. We continue to try to find solutions to the European energy crisis there, Matt. But here and now in the markets, a lot of risk aversion, gloom and doom being talked about quite a lot.
Yeah, absolutely. I mean, we see continued drops even after the fall in the cash trade yesterday. The continued drop in the cash trade yesterday, and now futures are off 0.8% this morning. So down below 3,600, and we came down pretty close to that in the cash trade yesterday. The 10-year yield rises right now at 394.49. I believe it's gone all the way to 399.
Yep.
Yes, thank you, Kaylee.
About 4%.
Touching the 4% level, but we haven't really gone through that. So we're on 4% watch, I guess. The 2-year yield is the highest since 2007, up to 431, and the 3-year at 435 right now. NYMEX crude coming down on those recession concerns. Jamie Dimon said yesterday on CNBC, expect a recession in 6 to 9 months. Of course, a lot of people think we already had a recession, depending on how you define it. Nonetheless, 88.71 is the level there. The China concerns had to play into this as well. Because of the restrictions Biden put on their technology sector, they said that their recovery will be slowed. And then Bitcoin, you know, it hasn't moved out of this 20,000 range, 19,081. For a while, I didn't want to put it in here anymore because it wasn't changing. Now I think it's interesting that it isn't. I mean, we just don't see Bitcoin breaking out of this trading range, Kaylee.
Yeah, it's interesting, and we've heard from a couple of voices that may be due to the fact that you are seeing more institutions in the space rather than just retail investors, and those institutional investors may act as somewhat of a stabilizing force. That is a conversation we will continue in just a moment here on Early Edition, and of course, you and I will have more on that on Bloomberg Crypto later today. As for what is happening right now in pre-market trading this morning, you're seeing energy under pressure with oil prices down, as Matt was talking about. The likes of Marathon Oil, Occidental Petroleum, each down in the ballpark of about 2.5%. But of course, the sector that we all really have been focused on in the last several days is the semiconductors. A number of factors here, one being the Biden administration curbs on U.S. technology to Chinese chip makers, so that could rattle supply chains and potentially damage the revenue operations of U.S. chip makers who do business in China. But then also you have to consider the earnings picture with a lot of warnings out of these companies about slowing demand. So that is putting continued pressure on the space. NVIDIA down 11% in the last 2 days already, down another 1.5% this morning. And Advanced Micro Devices also down by about 1.3% before the bell, Anna.
Kaylee, here in Europe, we see continued pressure on European stocks broadly. Many sectors in negative territory today, down by 1.1%. Basic resource stocks, energy stocks, all of those feeling the pressure as we see weaker commodity prices. Growth concerns very much to the fore here in Europe today. This is what's going on with the yields on the 30-year gilt here in the UK. And actually, this stands in contrast to what we're seeing at other tenors of the curve here in the UK. So we heard yesterday from the Bank of England they were confirming they're ending their bond buying program at the middle of this month, but then they added another program that will run till early November. Today that didn't soothe the markets quite enough. We saw gilt yields moving higher yesterday. Today they came forward with another program. We heard about this from Danny Berger a little bit earlier on. This is inflation-linked gilts added into their existing programs, so they're now buying those as well, trying to stabilize those, stopping the surge higher in yields we're seeing there. And so what that did is it did actually soothe the markets a little bit, and we've seen that the yields have been coming down across much of the UK curve, but not at the 30-year, where we are seeing some selling of 30-year gilts and the yield going up, as you can see. Credit Suisse up by 1.2%. And this is, of course, in the run-up to the 27th of October when we get the full restructuring announcement from Credit Suisse. Goldman Sachs, though, trying to put a number on the amount of capital this business needs to raise. They say 8 billion Swiss francs, US dollars, almost the same. And so they're putting on a number on it, but maybe some people had a bigger number in mind. The stock is higher.
All right, we'll continue to watch that story for sure, among the most read on the Bloomberg terminal. I want to go though, back to the bond market right now. Let's talk to Nicola Mai, PIMCO portfolio manager and sovereign credit analyst. And those sovereign credits are getting more and more expensive, or I guess yielding more, depending on your view. Nicola, how do you see the rising yield environment?
Yeah, I mean, I think the rising yields, first of all, is a very good opportunity for bond investors that haven't seen these levels of yields in 15, 20 years. I mean, after minimum record lows for bond yields, we now have bonds that actually are interesting. In terms of what's priced in the market, I think the higher yields reflect the central bank credibility and their commitment to fighting inflation. And I think the kind of yields we're seeing now, like maybe 4.5% peak rate for the Fed, 5.75 for the Bank of England, 3% for the ECB, tend to be close to what we think are enough to actually bring inflation back down to target.
Nicola, can I home in on the UK with you here? We're just getting some interesting news lines coming through, which I'll add into the conversation. The Pensions and Lifetime Savings Association in the UK, and we know that a lot of what the Bank of England is doing is focused around the pension industry. That particular organisation is saying that some pension funds want the Bank of England to extend its bond buying. We know that the initial programme is due to come to an end on Friday, on the 14th of October. Just as we see those comments come through from the PLSA, I note that gilt yields have suddenly turned and are now on the rise everywhere across the curve, apart from the 3-year. What are you expecting to see then from the Bank of England?
So I guess the Bank of England, with its gilt purchase program, which started on the 28th of September and was actually expanded today to include linkers, it shows the central bank commitment, as you say, to stabilize the pension fund sector and LDI investors specifically. Now, it's very possible that the program, which, as you say, is due to end on Friday, will be extended, and I think that the Bank of England will be ready to do that. I think it's important to remember this is a financial stability operation. It's really a liquidity operation, which is independent of its monetary policy. So I think while continuing to provide liquidity, it will be important for the central bank to reassert its commitment to bringing inflation back to target. And that is with its policy rate adjustments, not with these measures, obviously.
Okay, so you say this is financial stability, a liquidity operation, it's not monetary policy, but monetary policy is looking like it needs to keep moving in the opposite direction. We got UK unemployment data today that showed the lowest level of unemployment in this country since 1974, and that was a lower level of unemployment than had been expected, a tighter labour market than had been expected. Nicola, is there a worry for you about what the Bank of England is doing in this part of the market versus the tightening course it needs to be on elsewhere?
Not necessarily. I think that if they help with liquidity in the long end of the curve, that's fine and needed in a way, as long as you say, as long as they actually show commitment to bringing inflation down. I mean, you're right that the labor market report showed a very tight labor market. Now vacancies are coming down and employment looks to be slowing, but at the same time, labor force participation remains very low. Which means that there has been a destruction of labor supply, which means that there's too much heat in the labor market. So I think as long as the Bank of England continues to raise the policy rate, as we expect they will do, these liquidity operations can come alongside it.
Nicola, to widen the lens back out, you mentioned the opportunity you now see in the bond market, that the case is getting stronger for investing in bonds. Could you get more specific as to where and where you might still be avoiding?
Yeah, so generally speaking, I would say that, I mean, right now we're not taking super strong positions on duration, meaning on interest rate risk, because there's still some uncertainty as to when and where inflation will peak. But generally speaking, we are thinking that the levels we're seeing, and I'm talking about treasury yields as well as gilt yields as well as bond yields, the levels we're seeing are getting more and more interesting. And as we get more and more evidence that inflation is brought under control, I think there's going to be very good opportunities for investors. I also think there are opportunities in the spreads, in the corporate spread space, in the credit space. Let's put it that way. We would really focus on high quality right now because we are expecting a recession. In Europe, it's almost guaranteed. It's very, very likely, but it's also more likely than not in the US. So we would tend to favor high quality credits over lower quality credits. We like structured products, which tend to have protection and decent yields. We also tend to like high quality financials where we see good opportunities. We also like some names in the emerging market space, but you want to be very selective there while the Fed is still hiking interest rates.
Okay, Nicola, thanks so much. Thanks for joining us. Nicola Mai of PIMCO talking to us about gilt markets, treasuries and beyond. When we come back, we'll get back to the crypto conversation. Anthony Trenchev joins us, Nexo's co-founder. What have the stresses and strains in the crypto space of late done to his business? How is his business right now? We'll talk about that next. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
The macro backdrop is really affecting us just as it's affecting every other asset class, just as we've seen in your graph there. What does that look like going forward? How cold does this winter get? Well, I think it's highly dependent on the macro situation, the Fed, policymakers in Europe, policymakers in the UK. Now, idiosyncratic crypto elements, we've seen plenty, you've reported on plenty over the last few months. You know, we think the leverage is out of this system now, for the most part. We don't see any massive shoes to drop.
Tim Grant, there, head of EMEA at Galaxy Digital, speaking with us yesterday. Joining us now for more on the crypto space, Anthony Trenchev, co-founder of crypto lender Nexo. Very nice to speak to you, Anthony. And we want to get into a conversation about your business specifically, about regulatory thoughts. But I want to ask you first about what Tim was just talking about there, about what's driving the crypto prices at the moment. He was saying he was facing up to the winter and saying it's been a tough macro backdrop, but he thinks that a lot of the leverage is out of the system and he doesn't see another shoe to drop. We've seen quite stable Bitcoin prices recently. What's your view?
Yeah, no, I completely concur with that view. The macro backdrop is what ultimately drives the market right now. Unfortunately, there has been some correlation direct between overall equities and crypto. Leverage is definitely out of the system. That's why we haven't seen any sort of drop below the lower range of around $19,000, $17,000, and we need some new impulses to get us through the higher barrier of around 25, which is the higher bound range.
Okay, Anthony, let me ask you about some of the things that have been going on from a regulatory perspective. Several states alleging last month that Nexo offered its interest-bearing crypto products to customers without first registering them as securities. Also suggesting there was misrepresentation as a licensed and regulated company. I mean, how are you responding to those kind of criticisms?
We pride ourselves in our transparency, and this is the approach we have always had with regulators. We are cooperating, providing the necessary and requested data in a timely manner. I was quite surprised that they decided to go public about something that has been ongoing for over a year now. We have been talking to federal and state regulators, figuring out what, if anything, we have done wrong in the past, but more importantly, how the path forward looks like. And that is what's got me terribly excited, because one thing is clear, it is that they want the earned interest product in the US in compliance with the regulatory framework, which is now shaping up nicely and clearly. And this is the good news, is crypto and the earned interest product in the United States is here to stay and will be, brought into its 2.0 version.
How long do you think this fight with regulators, though, is going to be drawn out, Anthony, both here in the U.S. and do you expect other regulators, other jurisdictions to have the same issues?
Matt, you know, I would love to talk about that, but you also know that I cannot talk about that. And as soon as I can, I will be on the first flight to New York to have a sit down with you and discuss it in person.
The invitation is always there. It's a standing invitation, Anthony. Let me ask about the yield then. You know, when I first talked to you, now I don't know how many years ago, I was astounded by the yields that you were offering, and it's been a huge draw for your products. Those yields are now a lot lower, and we see a lot of other, you know, plain vanilla yielding instruments much higher. The 10-year, as Kaylee was saying earlier, went over 4%. What are you seeing in terms of the relationship or the demand that investors have for your products now as, you know, plain vanilla bonds yield so much more?
Yeah, well, we have to consider that these yields are on fiat currencies only, so our offering for interest on digital assets remains very attractive, and we are one of the very few players that provide it, so no change on that. If anything, new players are coming in.
What are the levels you're offering right now, Anthony? Can you quote some?
We are offering up to 12%, depending on the structure of your portfolio and your loyalty tiers, but 12% is something you can get on fiat currencies, up to 8% on Bitcoin and Ethereum, so still higher than what most banks would have, even with the push of the Federal Reserve and the central banks. And institutions are coming in. Right now, it is not a retail-driven market. It's more an institutional-driven market, and they play it smart. That's why you don't see the slump below 19,000, 17,000, because all the institutions coming in to buy it up.
All right, so maybe blame the institutions for making the space a little more boring, or maybe that makes it more interesting. Anthony, Anna began the conversation talking about the difficulties many crypto companies have faced. A lot of leverage has gotten washed out. We've seen a lot of projects just collapsing entirely. You have pushed back on speculation about any kind of difficulty financially that Nexo is having. Can you give us more insight into your runway, and if regulatory issues here in the U.S. inhibit your ability to offer some products here, what would that mean?
Sure, we are in great shape, and this means that we have a very strong balance sheet. This means that we are the only crypto lender to have a real-time audit on our reserves to show that our assets exceed liabilities at all times. And what we talked about earlier, everybody that was going to go bust has gone bust, and we came out of this unscathed. Not only that, but we are in a position to help consolidate the space. You know, we are working, still committed to making it work with Volt, which was one of the lenders that got into trouble. We're doing, and hopefully completing soon, the due diligence and finding a solution. And so we are in a position to help consolidate the space. I think that speaks volumes in and on itself about how the business was developed, managed to this day. And this is the ultimate test, the reality of running a business real time.
Well, and just on the subject of deals you are doing, Nexo bought a minority stake in the U.S. Federal Bank Summit National Bank last month. Why do that deal?
Yeah.
What does that do for Nexo?
Well, we are future-proofing Nexo. This means that right now there is a bit of a turf war between regulators. Is this going to be under the SEC? Is it the CFTC? Where does the OCC fit into that? So it is a little bit messy. It's getting clearer, but you know, there have been some conversations about what goes where. So this is Nexo's approach. We work on several different fronts. So regardless of the outcome, we can bring our products and services to the U.S. client in a compliant manner. So, you know, having a stake in a federally chartered U.S. bank helps a long way, and we can use some of their licensure infrastructure to provide our services.
Anthony, thanks so much for joining us. We appreciate you stopping by the studio in London. You are welcome in New York City anytime. Anthony Trenchev there, the co-founder of the crypto business Nexo. Tune in, by the way, to Bloomberg Crypto. That's today and every Tuesday at 1 p.m. New York time, 6 p.m. London time. Kaylee and I are going to speak with Sheila Warren, the CEO of the Crypto Council for Innovation. This is Bloomberg.
do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up for the rest of the day. Ukraine will halt exports of electricity from today after Russian strikes hit power facilities. Facebook parent Meta also will be holding a conference on augmented and virtual reality. We'll have an interview here on Bloomberg Television with Cleveland Fed President Loretta Mester at 6:30 p.m. New York time. And the IMF releases its latest World Economic Outlook as the lender and the World Bank hold annual meetings in Washington. And Anna, we know they have much to discuss.
Yeah, absolutely. Much to discuss. As central bankers congregate at the IMF conference this week, we hear increasing calls for coordinated intervention to weaken the US dollar. Those calls, of course, from outside the United States in the main. Now, Bloomberg's Valerie Seitel is here to take us through why, in her view, blaming the dollar for its strength and blaming it on the Fed maybe misses the point. Valerie.
Thanks, Anna. Now, I want to draw attention to some very large structural shifts that are happening in a few of the world's massive economies. I've got the terms of trade here for the UK, Japan, and the Eurozone. Now, as the energy crisis has escalated, the terms of trade has deteriorated for these economies. That's mostly because they're importing prohibitively expensive energy. Now, you cannot deny that running these deficits, having this deterioration in the terms of trade, inherently weakens your currency. And in effect, by running these deficits to bring the capital back into a country, you need higher yields. So you need to entice these people to, or entice investors to fund your deficits via a weaker currency and higher yields. Now the UK and the Eurozone specifically are attacking the energy crisis via huge fiscal spending. What does that do? That keeps internal demand really high. That keeps your demand for this expensive energy really high. And it will exacerbate these deficits. Now you can't just put the dollar strength all on the U.S. because you have to realize that the actions by the UK, the actions by the Eurozone, especially Germany with their big fiscal spending packages, are pushing this narrative and pushing their currencies weaker.
Yeah. Yep. Okay, and so that's a sort of fundamental reason as to why we see weakness in other currencies, as well as the sort of the move into the safe haven of the dollar, Matt, which is something we've seen as a very regular phenomenon during times of stress.
Yeah, exactly. I think Valerie made some really good points, and especially the German fiscal spending package has caused concern across Europe, right? They're spending 200 billion euros. Other countries either can't come up with that or can't borrow it as cheaply or aren't willing to do it. And that's why they're starting to talk about shared borrowing now, shared debt.
Yeah, absolutely. Thanks to Valerie Teitzel for bringing us that chart. That is it for Early Edition. More surveillance still ahead. They no doubt will bring you a focus on some of those IMF voices that we're hearing from this week. They'll also speak to Mohamed El-Erian, who writes for Bloomberg Opinion, of course, and advises Allianz. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
Hard landing is very likely because the labor market has gotten too tight.
This is an environment where the bond market vigilantes are back.
You're seeing spreads stay wide and stay sticky.
The Fed is, with the jobs report, is really indicating that they'll probably continue on hiking in a more aggressive fashion.
I think there's worse to come for the market, unfortunately.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance. I'm Jonathan Farrow. Together this morning with Greg Peters of PGIM. Lisa Abramowitz coming up a little bit later with some special guests, including Apollo's Jim Zalta. Looking forward to that. Futures right now down about 1% on the S&P 500. Greg, perfect timing because we've got a lot to talk about in this bond market. The Bank of England, busy the last couple of days. What do you make of what we've seen this morning?
Well, I see the Bank of England continuing to have their back against the wall. They have no choice in the matter. They're trying to deal with this political situation that's reverberating across the system. LDI is the new acronym du jour. And so I just think they're stuck, and you're setting up for a showdown. I think that's the story. You're setting up for a showdown as you basically have the program ending, QT beginning again and the budget being due all on the same day.
Well, as you say,
right after the Fed.
We've got a date for the showdown, haven't we? October 14th is the first date. Greg's going to be with us through the hour on a lot of this. Greg, this is what they said in their statement. The bank plans to end these operations and cease all gilt purchases on Friday, the 14th of October. Do you expect to wake up Monday morning and see this continue?
You know, anytime you draw a line in the sand, that's generally a bad idea, right? It's the Maginot line I think they're drawing. And so I really worry about that as the markets will test them. And I think most investors believe that this is a program that has to continue, whether they state otherwise or not.
Some tension in this bond market. Equity futures, as I say, down about 1 full percentage point. I'll whip through the price action for you briefly. The Treasury market, the cash Treasury market reopening in America with yields higher, equities down, yields up. How many times have we talked about that? Equities down 1%, and yields look a little something like this on a 10-year Treasury. On a 10-year right now on my screen, yields higher by 7 basis points, up to about 395.11 on a US 10-year. In the FX market, euro dollar unchanged at 96.99. Call it 97. Crude down by about 2.6%, $88 and about 74 cents. Greg, I've got to pick up on the move in euro dollar. We're not going anywhere this morning, but there's 2 points of tension in the global bond market. One's the gilt market, the other's Italy. Yesterday, briefly, through 250, Italy over Germany. Then we put out this story about possibly a mutualization of debt, the effort to offset some of the pain on the energy front. Can you tell me how much tension you're seeing play out in the European bond market?
Not a tremendous amount as of yet. I mean, that is the tension point, that story that was kind of about yesterday. The Germans tried to dismiss that at the same time, threw some cold water on that, Jonathan, I'm sorry to say. But ultimately, it just shows with higher rates, fiscal issues, the ECB has the same challenges as the BOE. And they have to keep together. They have to keep funding liquid across all the different jurisdictions across Europe.
You
no
mentioned
easy
the
task.
acronym in the UK. We can talk about the acronym in Europe. TPI, Transmission Protection Instrument, not activated right now. Do you expect that to be activated pretty soon?
I think, once again, you draw a line in the sand, the markets will test it. And so I think as we enter the cold winter months, I think that pressure will likely ramp up, and you'll see that get activated one way, shape, or form. Details matter, and so we're all wondering what that means, Jonathan. And so, once again, the markets will test it, as they always do.
George Concalves joining us now, the head of US macro strategy at MUFG. George, I'd love your thoughts on the UK first of all. I think one conversation we've all had over the last few weeks is how unique these problems are to the UK, the potential for spillover from the UK to the global bond market. Can you walk us through, George, those two particular standpoints?
Hey, good morning, John. Yes, definitely the bond vigilantes have shown up first in the UK market, but with it, they kind of dragged up all global rates. I think that's the big issue here, that we've had years for this QE policy globally set and anchored rates globally. U.S. markets benefited from the back end of it, and now, we're clearly going to see what happens in the UK. But I think, for the U.S., the Fed has a similar problem too. I mean, we've had 2 attempts in the last 3-4 months of trying to call the pivot. The pivot team has 0, and the roaring bears are 2 right now. And I think that the bears are going to win at least for the next couple of weeks.
George, in Japan this morning, we put out the headline about 40 minutes ago. The 10-year bond in Japan hasn't traded for 3 days for the first time since 1999. George, can you even call some of these bond markets?
They definitely need to open up and get more liquidity, that's for sure. And I do think that that's just another example of just how when you get so involved, intertwined in your markets, it's hard to kind of pull yourself out.
Hey, George, it's Greg. Good to see you.
Right.
How do you see the correlations playing out over the near term? So one of the challenges that we have in the bond market is that it's a bond market of one. So before this all kind of started, you'd have allocations in one market versus the other. Today it seems like one. How do you see that playing out over the near term, and do you see that breaking?
I think at some point it does break, but I think the Fed is leading the charge. But although I think we've seen a global rise in short rates, at some point there's going to be a kind of a splitting off between the central banks around the world, and the Fed probably keeps going forward, and the BOE and the ECB is going to have to kind of run out of fuel, and they can't really keep going further. So I think the correlations will probably shift further to the back end, the 10-year sector plus, where you have real risks of big bear steepenings over the course of the fourth quarter.
And then how do you see the ECB being challenged over the winter? Jonathan and I were talking about it right before you got on. Do you see that being a real part of the risk factor heading into the winter?
Well, look, if there's any central bank that can actually turn, maybe not dovish, but could probably pivot sooner, is the ECB, because they're going to have the challenge between, really thinking about growth versus inflation and that fight. And considering that, growth is really going to decelerate, it has been decelerating in Europe, I think the ECB would be the one to kind of take a pause first. Doesn't mean that they're done tightening, but it could be like a two-stage tightening cycle where they have to get through the winter and then pick up the pieces in the spring.
We've all got to talk about trade-offs then. Vice Chair Brainerd came out yesterday with a long speech. I read it for us so you don't have to, George. I'm sure you did anyway. This is what Brainerd had to say. Greg, I'd love your thoughts on this as well. In this environment, a sharp decrease in risk sentiment or other risk event that may be difficult to anticipate could be amplified, especially given fragile liquidity in core financial markets. In some countries, she went on to say, the realization of these risks could pose challenging trade-offs for policy. What are the policy trade-offs if you're doing this right now? Is this a decision between getting inflation down and maintaining financial stability? Is it one or the other? Can you do both at the same time, Greg?
I think it's really hard to do both. And I think what the market has missed throughout the course of this year is that the Fed and central banks globally are fighting inflation. This is very different than what we've seen over the past many decades. And I think financial stability has also been kind of thrown in for quota the Fed put and other types of things. So like functioning markets is what matters to central bankers, not that prices are lower necessarily, right? And so I think, this is just another kind of spin on traders and investors hoping to get bailed out by central banks.
Reminds me of 2018 then. What was the difference between now and 2018? Because last time they backed off and said it was about functioning markets, that markets weren't functioning. What's the difference between now and what happened in late 2018?
I don't know. That's a good question. I mean, it's all blurred. 2018 sounds like three lifetimes ago.
Three decades ago.
But I think, 2020 is a better example, actually, March of 2020. The reason why the Fed stepped in initially was because the markets were completely broken. So you could not trade U.S. Treasuries, and we're not quite there yet. So liquidity is impinged in the Treasury market, absolutely. We just talked about JGBs, not trading for 2 straight days. That seems to be common practice there now. So I think central banks are focused on function, not pricing.
George, do we have a market functioning issue that this Fed needs to respond to anytime soon?
I mean, look, in the U.S. markets, they're still functioning, but liquidity is kind of dear, and and sizing of trades are probably going to keep getting scaled down. We're also heading into the end of the year, and after such a tough year that we've had, and you would expect people to pare down risk anyway. And balance sheets are scarce. And so I think we are at the kind of toughest spot, in the year. So if liquidity risks were to get worse here, I think, yes, it wouldn't matter. But at the end of the day, which markets does the Fed really care about? It's really the bond market. It's the foundation of everything, the repo markets. And the Fed has a lot of tools they put in place since both the COVID crisis and financial crisis. So I think they'd probably let the first lines of defense hold and see how that would work before they would actually pivot anytime soon.
One last question for you both on this, and George, first to you. Is the 10-year a buy again? Every time we get close to 4%. We got to that level, then backed away. We're kind of getting close to that level again, up 7 basis points today and back to 395.
Look, I mean, I think we're at this tough spot. I mean, I'm more concerned about equities than I am about bonds at this point. I think that bonds could benefit from one last flight to quality type move. I don't think it kind of pivots the Fed, but if we have another kind of equity move down 5-10% in the coming weeks, and bonds will rally on that. And then the question is, does the Fed blink? I don't think they will.
Hey, George, thank you, sir. As always, George Concalves there of MUFG. Greg, your thoughts on that? A buy, leaning a little bit into the 10-year, into the 30-year space?
Well, so I think we're closer to the end than the beginning, to state the obvious.
Yeah.
And so above 4% and where real rates are does present value. Will you be able to time it? Absolutely not. I think you need to see the cresting of the front end. I think you need to see rhetoric change, all these types of things, but you are getting close to it. And so I see a lot more value, let's say, in the U.S. Treasury market than I do in some of the credit markets.
So on mornings like this morning, with the screens we've got in front of us right now, your Bloomberg, my Bloomberg, what are you doing on a morning like this morning, Greg?
Well, it's still early, Jonathan. I'm still watching it, but no, I mean, you have to take a longer-term view in this market. I think trading this market is incredibly difficult. So yeah, you modulate here and there, but you have to have a North Star view, and our North Star view is that there is value, but we're not getting kind of chopped up and just brought in. So I think you have to be disciplined. You can't just kind of watch the screens as it just makes you mad.
395.31. Watching the screens and getting mad this morning. Yields higher by 7 basis points. Greg Peters of PGIM sticking with us through the hour. In the next hour, we'll catch up with Gargi Chowdhury of BlackRock. We'll also be catching up with Mohammed Al-Arian, who will be with us through the 7 o'clock hour to break down some of these issues. In just a moment, we'll hear from Maria Tadeo over in Brussels on the potential, the possibility for maybe a joint jet effort in Europe, and potentially a lot more cold water to come from the Germans. From New York City this morning, good morning. Equity futures are lower by about 1 full percentage point. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A group of 7 leaders are scheduled today to hold a call during which Russia's strikes on civilian targets are set to top the agenda. Russian leader Vladimir Putin has said the fresh assault was a retaliation for explosions on a multi-billion-dollar bridge connecting Russia to Crimea. Ukraine has not claimed responsibility for that incident. We traded near the highest level in more than 3 months as Russian President Vladimir Putin threatened more missile strikes across Ukraine. The escalation has sparked more fears that harvest and transport in the country will be cut even further. The agreement over the Black Sea export corridor comes up for renewal next month. The heads of the IMF and World Bank are warning of rising risk of global recession. IMF Managing Director Kristalina Georgieva says higher interest rates are adding to debt pressures on developing nations. She says about a third of the world economy will enter recession this year or next. And Bloomberg has learned the UK is pushing ahead with plans to set a cap on the revenues of renewable power producers. Government officials held talks with energy companies on a mechanism similar to the one proposed in the EU. The move would limit revenues and channel the funds to help struggling consumers. And more allegations in the Elon Musk and Twitter battle. Bloomberg has learned that just before the billionaire revived his proposal to buy the social media company, he accused Twitter of ordering a whistleblower to destroy evidence. According to court filings, Peter Zatko said he burned 10 handwritten notebooks and deleted 100 computer files at the request of managers as part of a $7.8 million severance package. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
The Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
There's the risk and the real danger of a world recession next year. The advanced economies are slowing in Europe. The debt levels for the developing countries are getting more and more burdensome. The rise in interest rates puts added weight on it. And inflation is still a major problem for everyone, but especially for the poor.
David Malpass there, the World Bank president, alongside the IMF managing director, Kristalina Georgieva, in the last 24 hours. Alongside me through this hour, Greg Peters of PGIM. I'm Jonathan Ferro. Greg, when the IMF and the World Bank start saying it, do you start to get the itch to lean the other way?
Yeah, well, history definitely tells you that that's the case. It's very concurrent forecasting, I think. But it just speaks to just how much negativity. Like, this is a recession that's been talked about for the past 9 months, and the data aren't quite there yet. So I think we have another 6 months before things start to play out potentially. So this has been what we call a slow-moving train wreck, and the IMF and World Bank just getting on board is just testament to that.
A slow-moving train wreck over in Italy as well. 10-year yields in Italy this morning up another 12 basis points, back to 474. Big round trip in the last 24 hours. Our story in the last day or so that Germany is going to back joint EU debt for loans to ease the energy crisis got a little bit of pushback from the German government in the last day or so, the last 12 hours. Maria Tadeo joins us now, Bloomberg Europe correspondent out of Brussels. Maria, walk me through the German response to our story suggesting that they're ready to back joint EU debt for loans to ease the energy situation.
Well, Jonathan, you have one source that doesn't go on the record and says the German government is not aware of this plan. But I think you need to take a step back and see how the German government operates at this stage. This is a three-party coalition. Of course, a Bloomberg story mentioned that is Olaf Scholz, the German chancellor, who had, well, a change of heart after he met with European leaders last week. What I can tell you is that for a week, something has been cooking in the behind the scenes across Europe. There was a lot of pushback to the initial 200 billion euro stimulus plan that Germany put out. In the Eurogroup, you could hear a number of countries very openly saying we will need some type of joint response. Otherwise, this is going to be each nation to their own devices, and therefore there's going to be a problem when it comes to the fiscal capacity. And then when the German chancellor met with European leaders last week, well, he heard the same message. There was also a lot of criticism that Germany did not coordinate well, that Germany did not have a lot of communication. What I would say, though, is that we're at a stage where this is an open debate, where there's an actual behind-the-scenes tension in terms of how to respond to the energy crisis and do it jointly. This is not going to go away. And if you ask me, the choreography from now on will be listen to energy ministers today, wait for the European Commission to put something on paper, and then this time next week, European leaders will have to decide on something, whether this is joint debt, whether it's a price cap. I think that remains to be seen, but there is a debate.
Well, let's talk about the approach to that debate. Is it over loans or grants?
No, this we have to make very clear, because we've never talked about a recovery fund. If you go back in time, and again, you have to allow me 30 seconds, a very technical talk here, but if you go back to 2020, this was the recovery fund. It was the wow moment for the European Union. They went jointly AAA rated debt to the market and then distributed that in grants and loans. What we're talking about here is a plan that came before the recovery fund that was known as the SURE, but everyone forgot about it because it was eclipsed by the big fund. Now, the idea here is that as the EU, you go to the market, AAA rated, you lock better funding costs, and then you get that to member states, but they will have to pay it back. The only difference is that if you're Italy, you probably want to do it at that rate and not have to do it independently on the market, because you're not going to be able to lock such an advantageous rate. That is where the debate is at. Nobody's talking about a recovery fund 2.0. We have to be very precise about this.
Maria, wonderful to catch up with you. Maria Tadeo out of Brussels on the latest effort. Greg, does that get it done for you? Is that enough to put a lid on things over in Italy if this gets finalized?
It helps, absolutely helps. It definitely allays a major fear that the markets have, where the ECB will lose control and the ability of these peripheral countries to fund themselves at a time where they need the funding. So I think this absolutely helps. And the closer you get Europe together as a fiscal union, the better off we are.
How do you compare what's happening now to, say, 10 years ago, when the epicenter, the catalyst for the crisis, was on the periphery, and now arguably the epicenter of this is in Germany? Greg, that's quite a change.
It is a change, and I think it matters, and we can kind of think cynically about it, of course, but what it is a process that I think pulls the core to the periphery instead of the other way around, and maybe just perhaps Germany seeing the value of having a more fiscal union and an aligned European Union.
Does that present opportunity in Europe in a way that perhaps there wasn't an opportunity before we got the whatever it takes moment with Draghi?
I think so. I think so. I mean, if you go back, Europe was trading as a single marketplace. That obviously blew apart, and it continues to be quite fractured. But I think it takes less pressure off, just call Italy, and puts more pressure on Germany. And all else equal, that's not such a bad thing.
So is 475 a good thing on a 10-year for you and the team? Is that something you'd buy?
For Germany?
For Italy?
No.
For Germany, I think you take 475 in a heartbeat. For Italy right now?
Once again, I think it's too early, right? The challenge that I think investors have is the extreme volatility. And so we're focused on gilts, of course, right?
Sure.
When it swung 100 basis points in a day, but it's happening all over. And so it's hard to really put a stake in the ground. So the vol is so extreme, I think it keeps capital out. So you need to dampen the vol, which is what I think these programs do and central banks try to do. And then investors start to enter the fray.
I've been so surprised by how ambitious the ECB has been in the last couple of months. We're having another conversation about a 75 basis point hike. And Greg, if I go back to the conversations we'd have in the pandemic, I think if you'd asked me, I was pretty open about it at the time. I was seriously sitting there thinking we could go another full cycle without a rate hike from the ECB. I wasn't alone. Other people were saying the same thing. And here we are talking about 75 again at the end of this month. Do you think that's doable without causing some real issues?
I think it is. And I think the ECB has been allowed to get out of the trap, right? So look at what's going on in Japan, right? So, the BOJ is stuck, right? And they're stuck as far as the eye can see. And I think that has clear implications. So I think the ECB is using this as an opportunity to normalize rates, as I think, history will shine a very unfavorable light on negative rates. And I think they're trying to get as much room as they can. So when things do slow, they can cut again.
Are we leaving behind this era? There are some people who believe we're just going to return to it in a couple of years' time. Do you think we are firmly leaving behind this era?
I think so. I think we're moving out of this central bank dominant phase, that era. Like I said, I think history is going to look back on that and go, God, that's a really bad idea. You're destroying savers. You're destroying insurance companies. Look at the fallout on the LDI side, right? That's just an artifact of the change in policy and how difficult they had it over the past number of years.
Let's hope we can get to a better destination. It's certainly painful making the transition right now. Andrew Hollenhorst of Citi is going to be joining us shortly. Andrew's looking for another 75 basis point hike from this Federal Reserve at the start of November. Coming up, Andrew Hollenhorst of Citi alongside Anne-Marie Hordern, AMH out of DC. In the next hour, we'll catch up with Mohammed Al-Arian right here around the table in New York City.